E-mini yesterday rallied and had a double top at the end of the day, double top major trend reversal and a sell-off, but it's also basically a high two, leg one, pullback, leg two. I think the most important thing going on with the charts right now is the daily chart. We have three moving averages above. Institutions look at the 50-day and they look at the 100-day, the 150-day, the 200-day, and the 100, 150, and 200 are clustered together. Each one's a magnet, and you have three magnets together, so we're probably going at least a little bit above that. And they're right around 3,000, the big round number. We might get all the way up here. That's that March 3rd high. We have a spike pullback channel. I thought we would get there at some point this year. I did not think we would get there just a couple months after the sell-off, but we may get there. And when you have a spike pullback channel and you test to the start of the channel, usually you get a reversal and then the market enters a trading range. So I think this is going to end up as a bull leg in a trading range. There's no top yet. We had a credible top, 1, 2, 3, a wedge, but the channel was tight. We got a reversal down and it became a high one bull flag. The bears are hoping that we get a double top with that high from a couple weeks ago and break below the neckline and measure move down. But with all of these magnets above, three moving averages, 3,000 plus that high, I think we're going to go higher before the bears can get the reversal down. Broke above yesterday's high. Yesterday was an outside up day. Most outside up days do not get far above the high of the prior day. And yesterday was an example. We went a little bit above, and then we pulled back below yesterday's high, and now we're breaking above it again. And we also went above last week's high. And on the weekly chart, we have a bull trend, and last week was a pullback. This high is below that high, so it's a high one bull flag. And we also had a sell signal here at the moving average, but a 6-bar bull micro channel. The best the bears were likely to get was 2 or 3 weeks down. They got just 1 week down. The bulls were so eager to buy for 6 weeks, they were buying above the low of the prior week. And last week, they finally got a chance to buy below the low of the prior week, and they took it. So it looks like we're going to break above that high, the sell signal bar on the weekly chart. And the top of the 2.5-year trading range was around here. We broke above it, and then we broke below it. Now we're back in it, and we're again testing up near the top of the range. So what do you do here? Well, it's a gap up. It's not all that big. You can see we're hesitating at yesterday's high. We're in a resistance zone. On the daily chart, we have that wedge, 1, 2, 3. The bears are selling here, trying to create a double top. They're hoping this rally is just a test of this high and that we reverse down. Right now, I would say 45% chance we're going to get a double top with that high from 2 weeks ago, and 55% chance we're going up to at least a little bit above those moving averages. The first test of the 50-day, we went a little bit above and pulled back. And I think when we get to those averages, we'll go a little bit above and pull back. Traders will look at it and wonder, is it a pullback or a reversal? And I suspect it'll be a reversal. And that this reset the wedge count. We had 1, 2, and 3. Whenever 2 is very big, you got a 50-50 chance that it is a new 1. So 1, 2, and 3. And it looks like that's going to be the case here. Yesterday at this price, what did we do? We sold off. We sold off, and the bears are trying to sell off again. Now, sometimes when you have an outside up day, the next day is an outside down day. And it's unlikely, but it does happen. You know, maybe 10% of the time when you have an outside up day, the next day is an outside down day. Bears are hoping bar 1 is the high of the day. Yesterday, bar 1 was the low of the day. To sell below 1, the bears want as big a bear bar as they can get. Now, we accomplished something with bar 1. Yes, we went above yesterday's high, but in addition, we went above the Globex high. So that takes that off the list of to-do items. 90% of the time, the day session will either go above the Globex high or below the Globex low. And we've gone above the Globex high. The bears would like to get down below the Globex low. We had an outside bar up on the Globex chart here. Actually, it's 3, but this was an outside bar. This was another outside bar, bigger one, and this is a bigger one still. So we have 3 consecutive outside bars on the 15-minute Globex chart. And so it was a buy above the high of the second outside bar. It failed, and it's a sell below the low of that bar. So it's right now on a sell. You can call it a double top, and then we have an OO pattern, and now we have a third outside bar. So this 15-minute bar then is again another breakout mode setup. Bears theoretically will sell below, bulls will theoretically buy above. But that's pretty interesting. I call this green bar an outside up bar. It did not go above the high of the prior bar, but it got to the high of the prior bar. So to me, that's a variation of outside up. So this bar clearly is outside down, low below that low, high above that high. This one, we have exactly a high at that high and a low below. So I would call it a second consecutive outside bar. And then this is a third consecutive outside bar, outside up, outside down. So on the Globex chart, it looks like we're trying to go down. A lot depends on the next bar. This is the signal bar. So the next bar has to go below this low to trigger the signal. If instead it goes above the high of the bar, it triggers a buy signal. So what do you do here? Possible high of the day, but you're also in the middle of a 4-hour trading range, and that is a bad location to be selling. So if it is the high of the day, and if we're going to get a trend, there'll be plenty of other opportunities to sell. Right now, look where we are. You're in the bottom half of a 4-hour trading range. That is not a very good location to be selling. The probability is not very good, and the risk is big. You're risking about 15 points up here. So better to wait. As I said, if it becomes a big bear trend day, there'll be plenty of opportunities to sell where the risk is less and the probability is more. 60-minute chart, spike, pullback, wedge, 1, 2, 3, 4. So it's a possible wedge, double top. That's a common pattern. Very often a double top, the second leg up is a wedge, and then you sell off, break over the neckline, fall for a measure move down. So this is good for the bears. And 5-minute chart, I think the market is deciding what it wants to do. Is this a test of support, the moving average from yesterday's close and the start of a bull trend, or is it a reversal down from resistance, yesterday's high? It's both, and we don't know which is going to win. The market's deciding on the direction. No rush, right? You got 79 bars left to the day. So very easy to take early trades where the bars are big, the risk is big, and get a loss. Even if it's a good trade, you're still going to lose it, at least 40% of the time. And then you find yourself down, 8 points or 10 points on the first trade. And then as the day gets on, the bars get smaller, and it becomes very hard to win back your 10 points that you lost. And you spend the whole day thinking, oh my gosh, I should not have taken that first trade. You don't want to spend the whole day hoping to make back a loss that you got in the first 30 minutes. And you certainly don't want to spend the whole day. By the middle of the day, you start hoping, oh, maybe I can get back half of what I lost. Trading has to be fun. And if you get a big early loss, the day is not going to be fun. You'll spend the entire day worried about that one trade, and you'll end up missing a lot of other trades because all you're doing is thinking about the money that you lost. And you'll be afraid to take other trades, even good trades. So better to be patient. Now, I said for the bulls, this is an opening reversal attempt. A sell-off to resistance, sell-off to support, a moving average to the middle of the trading range, tested yesterday's close, and they're hoping this is the low of the day. Consecutive bear bars like that, most bulls are not going to buy above 2. But if 3 is a bull bar, you will get bulls taking that buy. Sometimes you get an opening reversal, you get a gap up, and then a brief sell climax, just 1, 2, 3, 4 bars. So here's the moving average. We gapped up, we had a big bear bar, a good bull bar, a decent bull bar, and then another good bull bar. And all it is a test of support. Sell off down, in this case, to the 60-minute moving average and the 5-minute moving average, and reversal up. Now, this is the climax, not that. So I'm going to move this slide. It really does not belong here. Another example of a sell climax on the open after a gap up, and simply a test of the moving average. Here, again, a test also of the 60-minute moving average and an early low of the day. I was in the wrong section. This is where I really wanted to be. 4 bear bars, yet low of the day, gap up and a sell up. 4 bear bars, you start to get bull bars. Traders will start to buy above bull bars. Here we got a couple bear bars testing the moving average. Big sell off yesterday, but early low of the day. Tried to go up a second time, and then we got 2, 3, 4 bull bars. You'll get more and more bulls willing to take the buy. Here we go, 5 or 6 bear bars. No bull bar for the first 8 bars, or maybe a tiny bull doji. Yet it was simply a test down to support, moving average, yesterday's close, and an opening reversal up into a bull trend. 3 big bear bars. Did not matter. We got a reversal, traders bought. We got a swing up. 1 sell climax, reversed up. A bigger sell climax. It converted into a wedge bottom and then a reversal. The point I want to, actually, this is the open of the day right here. So 3 big bear bars in the open, tried to reverse, and tried to reverse a second, third time. Bull bars closing in at highs, traders start to buy. A lot of bear bars on the open, simply a reversal up. Huge sell-off on the open, testing yesterday's low, support. A doji, some will take that buy. I usually wait for bigger bodies, so I would buy above that or that. And tails, probably a minor reversal, which it was. We ended up going sideways for several hours, and then a little breakout to the upside. A lot of bear bars on the open, reverse up. A lot of bear bars on the open after a gap up, opening reversal up. So the point I'm making is, just because you're seeing a lot of bear bars on the open does not mean you're going to end up with a big bear trend. The low one, for the bears, this is a bear trend. We have a bear inside bar closing near its low. So it's a low one sell signal. That's a credible sell. But I still think the odds are this is a test down toward the bottom half of the range. Remember, on the 15-minute chart, we now have outside down bar, outside up bar, outside down bar. So the low of that 15-minute bar is a sell signal, and that's the low of bar 2. Bears are trying to trigger the sell. They're trying to get below the 2 low, and bulls are trying to prevent the sell from triggering. Okay, just triggered. So that's a 15-minute sell signal on the Globex chart, not on the day session chart. Day session chart, 15-minute chart is simply a single big bear bar. So it's not an 0-0 on the day session. It's simply a failed breakout of yesterday's high on the day session. Are we always in short? In general, if we get consecutive bear bodies, I think of it as bearish enough to be always in short, so 1 and 2. But tails 1 and 2 lower the probability. So we did not reverse up from the moving average. We're next testing the support of yesterday's close. Great location for the bears. All right, we have a double top after a wedge top. 60-minute chart. Let me turn this into a 4-hour chart, 240-minute chart. So wedge rally, 1, 2, 3, and the second leg up is a smaller wedge, 1, 2, and then this is a little bit above that after a bear bar. So double top where the second leg up is a wedge back to the 60-minute chart. You can see a wedge better here, 1 or 1, 2, 3. So 1, 2, 3 or 1, 2, 3. Big risk for the bears, stop above 1. And as I said, if it's going to be a bear trend, there'll be plenty of opportunities to sell. If I was not talking, I would have sold below 3. That's a trade that I typically take, where you have a bear inside bar closing at its low just after the market goes always in short on the open. We have a gap up and a double top with yesterday's high being the first high. So gap up, double top, and the second leg up is a wedge. This is basically what the 60-minute chart is doing, a double top where the second leg up is a wedge. Daily chart, same thing. We've got a wedge, we've got one leg up, I'll pull back, a second leg up, I'll pull back, and then a third leg up, and it's a double top. Can you sell the market? I think it's better to wait. If you're not short, the one short I would have taken was, I probably would have sold the close of 1 if I was not talking, and I would have sold below 2 on the stop. But I would not sell here. The protective stop is too far above. You don't want to be risking 20 points this early in the day. Can you buy the close? If bears do not want to sell it, is it a good buy? I would not take it. It looks like the 60-minute chart is trying to go upside down, very close to upside down 60-minute chart. You can see on the 15-minute Globex chart, the sell triggered when we went below the low of the third consecutive outside bar. So a big bar like this, a lot of the bears will say, wow, that's a gift. I was not expecting that. And they'll take some profits. So you often get a bounce when there's a big bear bar late in a bear trend. Here are a couple big bear bars. Bears took profits. We're very close to outside down on the 60-minute chart, trying to go below that 80 low. On this new update thing that Ken wrote, so you go to the Brooks Price Action website, to the forum page, and then you click on the Brooks Trading Room private group. And then you click on the daily link for the webinar. And you scroll all the way to the bottom. And this is the stuff that I type. And it gets posted, I think, 70 seconds, a little bit more than a minute after I type. And abbreviations get expanded. Now, what about limit order bulls buying 80 low? Well, if I'm a computer, I'm buying the 80 low, I'm buying 1 or 2 points lower, 3, 4, 5, 6, 7, 8 points lower, betting that we'll come back above the 80 low. As an individual trader, I'm not doing that. This is down too strongly. When you get a big sell-off like this, let's say we get a reversal. It makes a big bull trend day unlikely. We could rally all day and get back up to the high. And I would not call that a bull trend day. I would call it a trading range day where we had a bear trend and a bull trend. But with this much early selling, we're probably not going to get much above the high of the day. If you have a lot of big selling on the open, you can trend up for hours, but you usually have a hard time getting much above the high of the day. This is similar to today. And it sold off for 4 bars, 5 bars, and it rallied for the rest of the day. So we had a bear trend and a bull trend, but the bull trend never got above the top. So you can call it a reversal day. You can call it a bear trend and a bull trend, but I would not call it a bull trend day. It's a day that has a bull trend. It's a day that has a bear trend. But at the end of the day, we closed below the open, so I would not call that a bull trend day. Another example, big sell-off on the open, and it reversed up for 5 hours, and we got a new high, but we could not get much above the earlier high. And that's what typically happens when you have a lot of early selling. You can rally first reversal up, typically minor. Sometimes it'll just keep going up and up and all day, but the odds of a breakout far above the earlier high, small. Same thing, rallied, same thing, got up near the high, could not break far above the high. A lot of early bear bars. You can rally all day, but you have a hard time getting much above that earlier high. Another example, became a trading range day, a bull trap, very strong breakout, and it just stopped. Some selling, reversal up, got a little bit above the high, could not get much above it. A lot of early selling. Here we did get buying into the close, but for the first 5 hours, it was a trading range day. Also, this selling, the bars are not nearly as big as what we have today. Right above the 60-minute moving average. And, look at this trading range here. Every now and then you'll hear me talk about a ledge. And a ledge is simply a tight trading range like this. And you have 4 or more bars in the range with exactly the same low at the bottom of the range. And here we have 5 bars with the same low, but we have 2 other bars that are a little bit lower. So it's not a perfect wedge, but it's like a wedge. The market repeatedly just kept hitting this price and could not get through it and went the other way. And now it's testing that ledge again. And this might be simply a sell vacuum test of the bottom of that ledge. It's not a textbook ledge. Textbook ledge, the 4 bars with identical lows are the exact low of the ledge. Here we had 4 bars with identical lows in a tight range, and we rallied strongly, but it's a magnet. 80% of the time it gets there within a day or so. Here we got there a couple days later. Here, 4 bars, identical lows, bottom of a tight range, big gap up, and we got below it. So you typically go below it and pull back above it, and then the market moves on and looks for something else. That's the end of the pattern. We have a ledge bottom and a ledge top. Ledge top, you expect a breakout above and a pullback below. A ledge bottom, you expect a breakout below and a pullback above. Ledge bottom, you expect a breakout below and a pullback above. And here we got a reversal above. Ledge bottom, breakout below, pullback above. It became a reversal. Common pattern. Sometimes you get ledge tops and ledge bottoms in the same tight trading range. So can you buy above 6 if it's a bull bar closing near its high? Possible low of the day. So some traders will take the buy. Other traders will wait for 2 bull bars or 3 bull bars and then buy. If you wait for more bull bars, the probability of a swing up is greater, but the stop is further away. A lot of times the first bottom will not be successful. A lot of times you get a bottom attempt and then you get a second leg down. Like here, we tried to reverse up, failed, we get a second reversal up. This buy never triggered. We never went above the high of that bull bar. Here's an example where it took 3 attempts before we got a swing up. So some bulls buy that and they buy more here, right? Other bulls buy that and they get out either maybe below that or below that, and then they buy the next reversal up. So you can see bears are buying back this shorts. We just went outside down on the 60-minute chart, traded above the hour high of the last hour, and then below the low of the last hour. And remember I said traders would buy that 80 low, or computers would. They'd buy more, 1, 2, 3, 4 points lower, 5 points lower, 10 points lower, expecting it to get back above that low because we're in a trading range, and most trading range breakouts fail. So if I'm writing a computer algorithm, you can be absolutely sure that I would have it buy that low and then buy more, and then get back to that low and take profits, break even on the first buy and profits on the lower trades. So even if you had a fund where you're trading, $100 million, to me, you'd still take this, that trade, and you trade small. So I don't know if the fund would be buying 1 E-mini, 2 E-minis, 3 E-minis, 10 E-minis, but that's what I would do. So I would probably have it buy, if I had a $100 million fund, I'd probably buy like 10 E-minis, 1 point lower, 10 more, 10 more, 10 more, 10 more, 10 more. Then it gets back up there. I'll average probably 4 or 5 points times 100 contracts. And if you got a $100 million account, that's a reasonable trade. You could do the same thing with micro E-minis. You buy the low, you buy more, scale in lower. But, if you're doing it, it's just hard to be doing that repeatedly. So, that kind of a thing where you're scaling in every 1 point lower, I think you can do it if you're doing automated trading. But if you're an individual trader doing it manually, very hard to do. All right, so for the bulls, an expanding triangle, okay, I'll break out below the bottom of the range. You can call it a wedge, 1, 2, 3. At a minimum, the bears get out above 6. And for the bulls, it's a credible low of the day, so it's an okay buy, but you have to trade small. And everybody knows we might get one more little push down. So some of the traders who buy here, well, most of you, the risk is big, so if you buy, you trade small, all right? And there are two or three ways to handle it. One is you buy and you put a stop below this. One is you trade small, you buy, and you buy more here, expecting it not to fall much more than a measured move down. Another is you buy small here, you exit below 5, and then if you get a second buy signal, you trade a full-size position. And for the bears, what do? I get out of shorts. Can you sell below 7? It's a low one in a bear trend. I would not. We're at the bottom of a trading range. We have a big reversal up. We're near the 60-minute moving average. So I think the math is not very good for selling below 7. What happens if 7 is a bear bar closing near its low? You might be able to get a scalp out of it, but it's probably not going to be much of a trade. This is what we might get. I think the choice is this, an unclear bottom and then 1 or 2 more new lows and then a reversal, or simply a reversal. So I think we're going to reverse. I've been talking reversal all day. It's because I think we're going to reverse. This is similar to today. And I think we might go to a new high today, but I think we'll have a hard time getting much above the old high. So for the bears, a low one, 7. But to take the short, the bears will need a pretty strong bear bar. They'll need a bear bar closing on its low with a decent sized body. If it's a bull bar, there probably will be more buyers than sellers below 7. Remember, I said if we go to a new low, there'll be buyers down here. Bulls see that they made money buying below 80, a prior low. If we go below this, they'll buy. We have support here, plus we already had some buying here. And they see that the limit order bulls who bought that low and bought more lower made money. So there will be bulls buying below 5. This is what I was talking about. We're always in short, and it's a low one. But everybody sees it doesn't look all that bearish. It looks like we're up and down and up and down and up and down. So we should go up. Markets deciding. Is this the low of the day, or do we get down to the 60-minute moving average? We're so close to the 60-minute moving average, I think we're going to the 60-minute moving average. So I think this is not going to be the low. 60-minute chart. We touched the moving average here, 60-minute moving average. We got near it here and reversed up. When you get near the 60-minute moving average, or any average, and reverse up, and then get another reversal down, the next time usually falls below the average. So we're probably going to go at least a little bit below the average, which means that the current low of the day is probably not going to be the final low of the day. So you get near it and reverse up without touching it. You get near it a second time. Usually it'll touch it the second time. Low one, but a bull bar. So a low probability sell. There might be buyers at the 7 low, and there probably will be buyers at the 5 low and the moving average. Stop entry traders, they could be long here and use a wide stop. I think it's probably better to wait for a second buy, wait for it to break below the 5 low and see if we get a second reversal up, and then take the second reversal up. So first reversal up, second 5 bear bars, I would not take that. But third, I would take that or this or that. This is what the bulls are hoping, that we have begun a channel up, and it's possible. But we have that special thing going on with the 60-minute moving average, and typically, if you get near it and then get near it a second time, the second time touches it. So I think we have not seen the low of the day. Nobody wants to sell below 7, but if 8 is a bear bar closing near its low, you will get traders selling below 8. And if 8 is a bull bar closing near its high, it would be a second reversal up, and you will get bulls buying. But as I said, even if we go up somewhere in here, I still think we're going below here today because of that pattern on the 60-minute chart. The same holds true with any time frame and any moving average or any support or resistance. If you get really close to it and then go away from it and then get really close to it a second time, normally you're going to go through it at least a little bit. Bulls trying to get a second buy signal above 8, but Doji 7, possibly Doji 8. So it's kind of looking a little bit like this reversal up, but hesitation. So, and bulls tried again and got a second bear bar. So I would sell below that outside down bear bar, looking for a new low, and I would buy back my short somewhere around that low. And the same is true here, except it's probably, you don't have to buy at the 5 low. You might be able to get a couple points below that because there's room to the 60-minute moving average. It would be better for the bears if it stays an inside bar and closes near its low for low 1 short and it tests somewhere below the 5 low. Bulls are hoping that this is the low of the day, but I know something they don't know. We're going lower. So it's a second reversal up, but I think the upside is limited. I think we have to get down to the 60-minute moving average. Not a great sell signal bar. So it makes the stop unclear. If you sell below 8, where's your protective stop? Is it up here? I don't know, but I do think this is where we're headed, whether we go down here or go up a little bit more and then down. Bulls trying to get that second buy signal. And normally I would say, yeah, it's a great buy, bar 9. But because of what's going on with the 60-minute chart, I think we probably have to go lower. 8 did not close on or near its low, so that reduced the number of traders willing to sell below 8. What just happened here? Why are we bouncing again right here? Because some bears have sold below 8, were disappointed by the bounce 9. They decided, maybe I'll get out break even. So they placed a limit order to buy back their short around that 8 low. And a lot of times they'll place the limit order a tick or two above their entry price, thinking that so many disappointed bears will try to get out break even that they might not be able to get back to 2 ticks below 8. Right? It has to go 2 ticks below 8. If you sold 1 tick below 8 and you're trying to get out 1 tick below 8, it has to go 2 ticks below 8. And there could be so many buy limit orders there that it won't get there. So a lot of the bears will exit 1 or 2 ticks above. Outside up, right, after an inside bar, but a bear bar, probably more sellers than buyers above 8. As I said, I don't want to buy until after we get below 5 and then reverse up again, or unless we break strongly to the upside, which would be a sign that I'm wrong, that we're not going down here. But right now, I think I'm right. Outside up, it would be better for the bulls if it closes on the high of the bar, above the 8 high. You'll get more bulls willing to buy above 9. I am not one of those bulls. I am a bull, but after it gets to a new low and reverses up, I want to see it get down here. Bulls want to get a breakout above 7, and a measure move up. And bears will sell the 7 high, just like the bulls bought the 81 low. Bears will sell the 7 high, they'll sell the moving average. And traders who prefer stops will wait to see if we get a reversal down on 10 or 11. we're getting near the end of the first hour. So what goes on here affects the appearance of the bar on the 60-minute chart. We have an outside down bar, and the bulls would like the bar to close above the midpoint. If the bears cannot get it to close on the low, their next goal is to get it to close above the midpoint. And below the midpoint, the bears want it to close below the midpoint, and then they can claim that they owned the bar. And the bulls want the bar to close above the midpoint of the hour, the 60-minute bar, and then they can claim that they were a little bit stronger than the bears. Bears want the low 2, the low 10 or 11, and bulls want 12 to close above that line. I still think the odds are we're going to a new low. But one very big bull bar here will shift the odds in favor of the bulls. I think we're going to rally today, but I think this is probably not the low. We do not have to get there in the first hour. In the second hour, we could get below the low of the first hour. To sell below 10, the bears would like to get a bar closing on its low, unlike 8. When you have a big tail below, that means there was buying into the close of the bar. That will reduce the number of bears willing to sell below that bar. Why? Because when it was at this price earlier, it went up. So you don't want to be selling there. A lot of bears will not sell there. And the opposite is true with buying above 10. If it has a fairly big tail on top, that means the market sold off at that price, the high of that bar. So fewer bulls will be willing to buy above 10 because you'll be buying at a price where the market just sold off. So they're trying to get 10 to close on its high, close above the 7 high, the neckline of this double bottom, and they're trying to get the close above the moving average. And they're trying to get the bar to be as big as possible. If they get all of those things, then the odds are this will be the low of the day. Right now, I do not think they will get all of those things. Until they get them, they don't have them. Decent bar for the bulls. We got a close above 7. So we have a double bottom neckline. Bulls want measure move up. You can call it a high 2, high 1, high 2 after a sell climax. But the close below the moving average and the bar is not particularly big. So I still think the odds are we're going down. The bulls need one more big bull bar to make me change my mind. Everybody's paying attention to the midpoint of the hour. Bulls would like bar 12 to close above the midpoint. That would be a sign of strength. And bears trying to get a sell signal bar 11 or 12 for a low 2, low 1, low 2. I do think we're going to rally for several hours today, maybe all day. But the selling is so strong, I think we're going to have a hard time getting much above the high of the day. So if we rally, it'll be one of these sell climax days where you rally all day, but never really get above the high. So you get a reversal day, down and up. You have a bear trend and a bull trend, but basically sideways. Never gets far above the earlier high. Bears trying to get as good a sell signal bar as possible for 11. Looking for a new low of the day, but probably buyers somewhere in this area. I said that I think we're going below the average price, 60-minute. You can get there 2 ways. One is you go down, and 2 is you just go sideways. So I think either we'll go down a little bit like that, or we'll do this, and the moving average will get drawn up below the low of a bar. You can see some bears sold 7 high, just like the bulls bought 80 low, and they sold the moving average. Anytime you have a possible bear channel, this could be a spike, pullback, and then a bear trend all day, you'll get bears selling the close of any big bull bar near the moving average. That's a fairly reliable scalp, and it can also be a swing trade. It never looks possible at the time, but it's a pretty high probability sell. you sell the close of a big bull bar at resistance if you think the market's still in a bear trend. Remember back here, bar 4, I said there would be some bulls buying the close, bar 5 buying the close. The bulls who bought the 4 close and bought more lower made money, right? Bears who sold the 10 close, if they were willing to sell higher, they would make money. Either it would go down and they could take a profit, or it would go up and then come back down. Not as good a sell signal below 11 or below 10. You got a pair of bull bars. So more limit order trading, buying below 80, buying below 8, selling above a bull bar 6, buying the bear close of 4 and 5, selling the bull close of 6 and 9 and 10. So lots of limit order scalping going on, and that's why we're going sideways. One more bar before the close of the hour, and the bulls would still like to get up to that midpoint, but if we do, it'll be a third leg up, 1 pullback, 2 pullback, 3, and therefore we could end up with a wedge rally to a 50% pullback. So not a very good buy above 11. Bulls trying hard to get 12 to close above that midpoint. Bulls want double bottom 7, break above neckline 10, measure move up, and bears want a new low of the day, which I think we're going to get. It's possible that this is a bear channel, spike pullback channel, and we end up with a big bear trend, but it's more likely that we're going to try to reverse up from around the 60-minute moving average. Bunch of bear bars rally, and then a series of very strong bear bars like what we've had on the open, and the market keeps bottoming, but every time it gets near the moving average, even with bull bars, traders sell, and it keeps going lower. So the bears are hoping that the sell-off that we've had is a spike down and that we channel down for the rest of the day. More likely, we're going to reverse, but this is what the bears want. Early sell-off, spike, and just channel down all day. Big sell-off in the open, lots of reversal attempts, and just sell off all day. Sometimes the channel can be very tight. Sometimes it's not so tight, but every time you get bull bars closing near the moving average, bears will sell the close of the bull bars, and they'll also sell reversals down from the moving average. They'll sell below bear bars. Bulls trying hard for a double bottom higher low major trend reversal, and normally I would be pretty interested in buying above 13, but I have a problem with that 60-minute moving average. This is a special situation. Bulls hoping bear trend, and we got a double bottom and reverse up. Sometimes the double bottom can be big, sometimes it can be small, reversal up, and then a double bottom higher low. So we have a higher low, and the higher low is a double bottom, and then bull trend. Another example, we're far below the moving average. We get a reversal up, and then a double bottom. Sometimes it can be big before you get the major trend reversal. It's good for the bulls, right? And it's a credible buy if 13 closes on its high. It's a credible candidate for the low of the day. What happened here is the bears tried to get down here. They tried again, failed, and they're trying again a third time And at some point, they're going to decide it's too low a price to sell. We're going to stop selling. We'll wait to sell at a higher price. The close of 13 is important. If it closes on or near its high, it's a credible buy signal. But if it has a fairly conspicuous tail like 6, I would not take the buy. I'd wait for a strong breakout above the moving average and then buy higher. Because right now the odds are we're going to go down here. But the odds can change pretty quickly in the next couple of bars. The close of this bar is important. If it closes on its high, like 81, you'll get buyers above, even though we're right below the moving average. If it has a conspicuous tail, like 9 or 6, you'll get fewer buyers above. Now, why did we go up here? Because 10 was a bad sell signal bar. It's a low 2 at the moving average, but 2 pretty good bull bars. So you have bulls buying the 10 low, and they buy more lower, including at the 9 low, trying to get back to the 10 low. And when it gets back to the 10 low, what do the bulls do? They sell, and boom, we get a tail on the top of 13. So they buy the 10 low, they buy more lower, thinking it's a bad sell, therefore there'll be buyers below. And when it gets back to their first buy, they exit, and that creates that tail. If you do not have that tail there, that would mean that the bulls are not exiting, that they're much more confident, and they're willing to hold, hoping that we're going to get a bull trend. So close of 13 is important. Okay, not a good bar for the bulls. For the bears, they have a resumption of the bear trend 11-12. I'll pull back 13, so theoretically it's a low 1 sell below 13. It would also be a failed double bottom 9-12, but not a very good looking stop entry sell. However, I still think the odds are we have not seen the low of the day. Because we're not getting good sell signal bars, 8, 10, 13, if it does go down, it's probably not going to be a big bear trend day. You know, normally in bear trends, you get decent sell signal bars. And if you keep getting sell signal bars and there's something wrong with every one of them, it's probably not going to be a bear trend, even if it goes lower. So sideways for 9 bars here, lots of tails, and limit order traders are making money. Buying below things, scaling in lower, selling above things, scaling in higher, buying bear closes 4, 5, 12, selling bull closes 6, 9, and 10. The bulls need a good entry bar because it's not a good buy signal bar, and the location's bad. Top of a tight trading range, right below the moving average. They need to get a bar closing on its high, far above the moving average and above the 10 high. If they get that, that would be enough to make traders give up on the 60-minute moving average. We got landscapers outside, so some noise. For the bears, head and shoulders top, bear flag, left shoulder, head, right shoulder. And they're trying to break below down to the 60-minute moving average. And the bulls are not quite doing what they want. They're trying. They have bull bodies 6, 9, and 13, but not bull bodies closing on their highs. And they're unable to break above the moving average so far. This is not like a 60 or 70% certainty that we're going down here. You cannot be doing this if the probability up or down is 60%. But it's more than 50% that we're going down, maybe 55% chance that this is going down, 45% chance that it's going up. You cannot be sideways if the probability is 60% going up or 60% going down. Because if it's 60% chance of going down, everyone's going to say, I got to sell, right? We're going down, right? So you can only do this if the bulls are still buying fairly aggressively. Nobody has given up. Tight trading ranges are magnets. So if you break below, you expect a reversal back up. If you break above, I'm less certain about a reversal back down because when you have a sell climax like this on the open, it's pretty common to reverse up for the rest of the day. Breakout mode, right? We're waiting for one side or the other to give up. So we're waiting for a quick breakout up or down. It could be brief. It could last all day. If it's up, I think it could last all day. If it's down, I think it's more likely to be brief. That will get a little bit below the 60-minute moving average and try to reverse up again. If you want, you can call it a triangle. You can call it a head and shoulders top bear flag. For the bulls, it's a double bottom. Anytime you're in a trading range, there's always both a credible buy setup, in this case, a double bottom, higher or low major trend reversal, and a credible sell setup, in this case, a head and shoulders top bear flag, left shoulder, head, right shoulder. Bears would like to get a good sell signal bar. They'd like 15 to close on its low and not go below 14. And the bulls do not have a good buy signal bar, 6, 9, or 13. So the bulls need a better buy signal bar, more sideways and a better buy signal bar, or they need a surprise bar up. This is triggering the sell, but not a great sell signal bar. Moving average, they sold it, 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 right? So bulls need to break strongly above the moving average to make those bears give up. Now, is that close enough to the 60-minute moving average? Probably not. I said I thought we had to get a new low of the day. It's a surprise bar. Break below the neckline of the head and shoulders top bear flag, but a tail. Close below the double bottom, good for the bears. But everybody, I think, is in scalping mode. Can you buy above 17? Fail breakout, double bottom, 5. I still think what I said on the open is true, that we got to the moving average here. We got near it here, and we're getting near it again. It would be unusual to get near it twice without touching it the second time. So we should get at least one tick below the 60-minute moving average. Bulls want double bottom, break above the neckline, measure move up. But chances are we're going to go lower. Bulls want double bottom and reversal up. But look where we are, near the moving average, and what has happened in this general price today. They've been selling at the moving average all day, and they'll probably buy at the 60-minute moving average if we get there. Possible low of the day, double bottom 5, but I'm not willing to buy right below the moving average where the bears have been successful 6 times in the past 7 bars. I am willing to buy, but I want a reversal up from the 60-minute moving average or a strong breakout, a closed bar above the moving average. That's a tempting buy setup, but it's forcing traders to buy right at the moving average. I'd rather wait to see it break strongly above the moving average and then buy. Trading ranges are always doing things that make you want to sell at the low, big bear bar 16, big bear bar 5, or buy at the high. Good bull bar 10, and then several attempts at high 2s and double bottoms. This is another double bottom attempt. This is the best looking buy attempt so far, but I still think we're going to have a hard time going up without touching the 60-minute moving average. But I will change my mind if the bulls get a very big bull bar here, especially like a big bull bar closing above the 10 high up here. Very good bar for the bulls. If it closes up here, that will increase the chances that we've seen the low of the day, and it will reduce the chances that we're going to get to the 60-minute moving average. I never get emotionally attached to any idea. You know, if I think something is likely and then it does what is unlikely, I just switch. Bulls, they need the close near the high of the bar and preferably above 10. Otherwise, you have to assume the bears are still willing to sell rallies. 18 ticks above 17. They had to go exactly 18 ticks for bulls to make 4 points. They buy 1 tick above 17. They place a limit order, 16 ticks, 4 points higher. It has to go 1 more tick to fill the order. So it looks like a lot of the bulls who bought above 17 took 4 points profit. And you have limit order bears selling 14 high, selling 10 high, scaling in, looking for at least a scalp. Okay, so it's good to get a close above the moving average, but we did not close above the 10 high. We did not even close above the 14 high. However, bears double top 10 are not going to sell below 18. They'll want it to go sideways and maybe get a micro double top. So it's still not clear. The bears had a chance 16, unable. Bulls have a chance 18. They had a chance 18, so far unable. Bears still willing to sell rallies. Are we always in long yet? We probably are. We have consecutive bull bars, 17, 18. One of them with a big body, 17, closing on its high. So that's usually enough to make traders believe up is more likely than down. Can you sell below 18? No. Can you sell below 19? Depends. If it closes on its low at the 18 low, then probably yes. But otherwise, I would wait for a micro double top in addition to the double top. So we have a double top, we have a double bottom. Remember, even though I thought we would go to the 60-minute moving average, I said I thought we would get a bull channel today, lasting at least 2 or 3 hours, possibly all day. But I thought we were going to get down to the 60-minute moving average first. The bears still hoping for a spike in channel bear trend, spike down, pull back, and now double top, break below the neckline, bear channel. But they should not have a lot of 17 to look like that, and they should not have a lot of decent follow-through bar 18. So the chance of a bear trend is less right now. Sometimes you just sell up and go sideways for the rest of the day. Right now, I think it's more likely that we're going to try to go up. But sometimes you have a gap up, a sell-off, and then you just go sideways the rest of the day. Big sell-off on the open, sideways. Big sell climax. We rallied a lot, but sideways all day. Sell-off, trading range, despite a very strong rally, still trading range. Can you buy the 18 low? I don't think it's bullish enough for that. You're buying in the middle of the trading range, and the bears have a double top, 10, 18 at the moving average. So not a good buy, not a good sell, better to wait. I won, but at the top of the trading range. So I think that's not a particularly good buy. It's okay swing. We're on the swing by 17, but why did 18 not close above 10? Why did it not close on its high? I won, always in long, but top of a trading range lowers the probability for the bulls. If you buy, where's your stop? Well, below 16. We might go sideways more before we go up. It still could be a bear trend day, but I think unlikely. I think right now it's more likely either going to remain in a trading range for several hours or will go up. But the bulls are not quite doing what they need. There's something wrong with everything. 6, 9, 13, not closing on their highs. 17 closing on its high, but a very big bar forcing you to buy too high. And now we have a high 1, but a doji bar with right after 18, a tail on top. So there's something wrong with everything. Increases the chances that we might be mostly sideways. Bears not only want bear bar 20, they want close on the low of the bar and close at or below the moving average. that would increase the chances that the double top will lead to a trade down, possibly high of the day. Whenever you have a double top or a double bottom, the second leg is often very strong. Bulls need to get a close or consecutive closes above 10, the neckline of the double bottom. And if they get that, traders will be pretty confident that we'll go up for at least a couple hours. Sell climax 4 or 5. So we're probably going to get to the 4 high at a minimum. I'm just not sure of the path. Is this the start of the move up, or do we have to go sideways, maybe down a little bit, maybe a double bottom and a pullback, and then a move up to the 4 high, maybe the high of the day? Bulls trying to get the breakout and measured move up, so let's buy the market. And they'll try to buy the close. They always want good follow through, right? If they can get a bull bar 20, that would increase the chances of this going up to the high of the day. At a minimum, I think we're going to the 4 high, the top of the most recent sell climax. Can you sell below 21? They'll break out. It's a surprise bar, 20, and typically you'll get at least a small second leg sideways to up. Bears hoping it's a bull trap, a breakout that fails, and that we continue down. Can you short below 21 if it's a bear bar closing on its low? With the 4 bull bars, I would not do it. Can the bulls get a bull close on the bar? That would increase the chances that we're going to get a swing up. And can the bears get the bar to close near its low? And it's a possible lower high and swing down for a bull trap. I would get out of longs below a bear bar, especially a bear bar closing near its low. And since it's a possible start of a swing down, some bears will take the sell. I think 20 is enough of a surprise that it's probably better to wait for a micro double top. So I'm not going to sell below 21. You get the sense that everything is disappointing, that you see something good, it makes you hopeful, and then you're disappointed. That's trading range type price action. And it's a sign that traders are taking quick profits. So they see something bullish, they buy, and then they take quick profits. They see something bearish, and they take quick profits on their shorts. Not a good bar for the bulls. It's still always a long. There might be more buyers than sellers below 21, but I think it's okay to get out of longs below 21 and then wait to see if 22 is a bull bar and buy again. And for the bears, I would not short. I would wait for at least a micro double top. So I still think we're going up at least to the 4 high. Moving average resistance, moving average support. So you get bulls buying around the moving average, testing the breakout point, the 10 high, the 18 high, the 19 high. Bulls trying to get a high 1 on 22, but they'd like to get a decent bull bar. The bears are hoping this is a bull trap and a failed breakout. And it might be, but I'm not willing to short yet. Another sign of trading range trading, just disappointing follow through up and down. Traders are scalping, taking quick profits. Not a good entry bar for the bears, and not a very good high 1 5 signal bar for the bulls. So better to wait. Still think we're always in long, so I still think it's better to be looking to buy, but that's not what the bulls want. 22, they wanted a bull bar. High 1, target a little bit above. But not a very good buy signal bar. Because it's not a good buy signal bar 22, you have some bears selling 22 high, some bears selling 21 high. But usually the market tries to get to sell climax highs. So I think we have to go a little bit higher. I said that 20 was enough of a surprise so that we would probably get a second leg sideways to up. And part of the reason why there's a tail 23 by the closed bulls, 20 disappointed, 21 somewhat more lower, but a lot got out break even when it got back to that 20 close. So that's a sign that bulls are giving up, still holding above the moving average and still a target above, but not nearly as strongly bullish as it could be. This would be a second reversal down from above 10, but we're still above the moving average, and I'm not going to sell below 24. You can see over here, testing the moving average, 6 different bars. They're selling every time they get near, and here, so far, bulls are buying at the moving average, and that makes me not want to sell below 24. 24 multiple of 12, the final bar of the hour. And for the bulls, it's a bull inside bar and a bull trend, so it's a high one buy. It's an IOI buy. We have an outside bar and then an inside bar, so you have inside, outside, inside. Bears would like the bar to be as weak a buy signal as possible. So bar 24, they're trying to have it sell off so that the bar does not close on its high. I still think that that 60-minute moving average is a problem for the bulls today. I thought we were going to get there by going down on the open or going down the second time. Did not. But we can still get there by simply going sideways. And that moving average, I think, might prevent the bulls from getting much of a reversal. It increases the chances that this would be one of those sell climax trading range type days instead of sell climax reversal day. Nothing to do right here. Tight trading range again, like here. So limit order traders are happy, right? They buy the 21 low, they sell the 21 high, the 22 high, the 23 high, and they'll buy the 23 low, the 22 low. Bears need to erase this. So they need a bear surprise bar. They would love to get something like 4, but they're probably not going to get it because that would be clear. And when the market's in a trading range, things are usually not clear. They're usually almost clear, almost really bearish, almost really bullish, and then they reverse. And since we're trying to go down, you got to be thinking that we're probably going to resume up. But the bulls would like to get a decent bull bar 25. Then it would be an IOI, micro double bottom, at the moving average. Traders betting on reversals. Bull bar 20, they sell it. Bear bar 21, they buy it. They buy more lower. Bear close 24, they buy it. Traders are betting on reversals. I still think, well, 24 did get to the target, to the sell climax high. You know, we could still get higher. You know, you could argue that the sell climax began here. You know, we sold off and bounced, and then we started down here. To buy above 25, it would be better if the bar does not get too big and if it closes on its high. To sell below 25, I'm not going to do it. If it becomes a bear surprise bar closing down here, I might sell it, but otherwise I'm not going to sell below 25. We're right at the moving average. It was resistance, and now the bulls are hoping it's support. And the bulls are hoping that we're in a bull channel. But real problems, you know, the bulls are not getting sustained buying, and the bears are selling bull closes. That reduces the chances of a bull trend. Sundays are really good days for stop entry traders, trend days. And Sundays are terrible for stop entry traders, trading range days. And this was briefly good, selling below 3. Selling below 4, I typically would not do it after a big bar, especially at the bottom of the range. And then in here, not very good stop entry trading. You know, borderline good, 17. but that was it. Maybe 19. And the bears have sold below 21. They can make a 1-point scalp, but not a 2-point scalp. So not very good. For the bulls, you can call it a high 1, a new high 24, pullback 25. The bulls would like it to close near its high. That will attract buyers. Bears are hoping outside down in the start of a swing down to the low of the day. But I don't think it's a very good stop entry sell right at the moving average. 60-minute chart, first hour, a big outside down bar could not go below its low. Second hour, a bull inside bar could not go above its high. So we're getting reversals. This is bulls giving up. So the bulls have bought above 20. Some did not exit below 21. Some did not exit break even above 22. And it looks like they're giving up here. So it's a little bit of a bear surprise, a give up bar. Bulls hoping for a double bottom pullback, double bottom and a pullback to a higher low. Sometimes double bottom pullbacks are big, sometimes they're small. Bear trend, double bottom, reversal up, big bear bar, but we got a higher low, so double bottom pullback. Here, double bottom, bulls are hoping this is a pullback with a decent buy signal bar. Double bottom pullback, double bottom pullback, bear bar. Doesn't matter, bulls buy above bull bars closing near their highs, looking for a swing up. Double bottom pullback, another pullback. Spaced out over a lot of bars, so a double bottom and a pullback. Double bottom and a pullback. Pullback here, another one here. Decent bull bar, good for the bulls. Small double bottom and pullback. Bulls 5 above a bull bar closing on its high. Double bottom pullback. Did not get much up, but it's still a buy above that bull bar. We have a double bottom and a pullback. Here, it's a smaller double bottom and a pullback. I would call this a double bottom, higher low, major trend reversal. And then the second low is a double bottom pullback. Small double bottom pullback. And the whole thing is a higher low, major trend reversal. And it's also nested in a bigger double bottom pullback. So a double bottom pullback, and within it is a double bottom pullback. Double bottom pullback where the pullback formed a perfect triple bottom. Double bottom and a little bit of a pullback. Double bottom, a lot of bear bars, but a pullback. Bulls hoping double bottom and a pullback. Best case for the bulls would be 26 close on high of the bar and at or above the moving average. That would be a reasonable swing buy. Possible leg 1 pullback, leg 2. But since it's a trading range day, there's something wrong with everything. So there probably will be something wrong for the bulls. Maybe prominent tail, maybe close below the moving average. This is a follow-through bar for the bears. They have a bear breakout of 25, close below 24, close below 22. So they're hoping it's a failed breakout above the neckline of this double bottom. Breakout failed, and they wanted to just trend down. But here's the breakout bar, 25. They want a bear bar follow-through. The bulls had a breakout bar 20 and got a bear bar. Traders sold it. We have a bear bar. If we get a bull bar closing near its high, you will get traders buying it. It's a credible buy for a double bottom pullback. Right now, we're still always in long. Bulls hoping that we'll get a bull trend. So far, all trading range trading after the first 5 bars, just reversing every couple bars. lots of limit order trading. Can the bulls get 26 close on high, close at or above moving average? If they do, it would be a reasonably good swing buy. If they do not, you'll get bears continuing to sell, expecting it to get to the 60-minute moving average at some point today. What happens if 26 closes on its low? That would probably make it always in short, and it would increase the chances that we're going down to the 60-minute moving average. Everybody always wants things to be clear, but in a trading range day, things are never clear. So things are confused, and when things are confused, traders do not expect big moves. They look for quick profits. They expect reversals. We're getting to the close of the bar. Is that good enough? Barely, right? I was going to buy above 26, but I wanted it to, the tail is, I think, a little bit big relative to the body, 2-tick tail, 3-tick body. So I'm going to wait. Also, I wanted it to close at the high of the bar and at or above the moving average. For the bears, it's terrible follow-through. They have a bear surprise 24, but disappointing follow-through 25. Some of the sell to close bears 25 will buy back their shorts at the 27 low around the 25 close. They'll try to get off break even. So it's a buy, but it's not as good as I think most bulls wanted. So a lot of the bulls will wait to see if we reverse up strongly and then buy higher. The bears see 26 as a breakout test of the 24 low, and they're looking for a measured move down. So we have a breakout, that would be a measured move down. Bulls were hoping that if the bears do get a second leg down, all they get is a second leg down, and that we get a reversal up for a possible double bottom pullback. For the bears, bear breakout 25, pullback 26. So theoretically, it's a sell signal below 26, but I think it's bad follow through, and this is not good stock entry trading. You can see bad follow through 2021, and there were sellers above the bear bar. And here, I suspect there'll be buyers not too far below 26. Bulls want to keep the double bottom. We can come all the way down to the double bottom, and the bulls would still have a chance of a reversal up. Low 127, but bull bar 26, tail 27. That will reduce the number of bears willing to sell below 27. Not great sell to close because we're right above the bottom of the trading range. Can you buy the close if you're not going to sell the close? I think it's better to wait to see if we get a stop entry buy. And can the bears break strongly below the 60-minute moving average? Probably not. Another bear breakout, close below 27, close below 26. Bulls hope wedge 1, 2, and 3, a wedge higher or low. It does not matter that the pullback from 1 went above the top of 1. A lot of the computers will still see it as a wedge and a double bottom pullback. The bulls need to get a decent bull bar. I think since 28 is a bear surprise bar as well, 29 would have to be very, very strong to make bulls want to buy above it. I'm not going to buy above 29, double bottom pullback, and a wedge. This is a bull trend, and this looks like a bull flag, a pullback in this bull trend. But tight bear channel and right below the moving average, and we have the 60-minute moving average, a magnet below. we may end up with a bigger head and shoulders top, left shoulder, head, and then right shoulder. I like to buy above bull bars. I like double bottom pullbacks, but it's a fairly tight bear channel, and it's right below the moving average. And the market has been paying a lot of attention to it today. Resistance, support, and resistance again. So I'm going to wait for stop entry trades. Bears will try to get double top 30, 26 at the moving average, and then a move down to the moving average. And bulls hoping that this is the start of a bull trend, but too tight a bear channel and significant magnet just below. So not good enough math for me to take the buy. I talked about that 00 on the 15-minute Globex chart. We had an 00 breakout mode pattern. The buy triggered, it failed, and then we got a sell below that low, and then we have a bigger outside bar, so another sell below that low, and it fell, I don't know, maybe 10 points or so. Bulls now trying for a double bottom pullback and bull trend. A situation like this, it's a credible swing setup. So maybe 40% chance that we're going to go up from here. That means 60% chance we're not, that we'll stall around the moving average, around the 26 high, maybe a little bit higher. Bulls want an upside breakout, and the bears want double top 26 with a decent sell signal bar 30 or 31. If it closes on its high, several ticks above the moving average, that will increase the chances that we've begun the swing up. And if it's a big bull bar, a bull surprise bar, that will attract a lot of buyers. But if it's not clear, you will get bear selling here. And to sell below 30, I think the bears will want a bear body. Is it buy the close? I think the bulls probably need one more bar. Like I said, we might be forming a head and shoulders top here, left shoulder, head, and right shoulder. Middle of a 2-hour trading range. The bulls have a credible setup, a double bottom and a pullback, but a very tight channel and a lot of trading range trading. And bears are hoping that we're going down to the 60-minute moving average. Bears trying to get double top bear flag 26 and 31. Double top bear flag 26, but 3 bull bars, so not a very good stop entry sell 31. Middle of a trading range. Bulls are hoping double bottom pullback, bull trend. Bears are hoping head and shoulders top bear flag and bear trend. But I think the minimum, well, I think the bears would be satisfied just going below the moving average or down to the moving average. To sell below 32, bears would like a bear inside bar closing on its low. Not a good sell signal bar 31. And bulls, they're disappointing traders. The problem with a tight bull channel and a stop entry, most of the time the breakout is minor and you have to go sideways before you can go up. Normally a tight bull channel will not reverse into a tight bear channel would not reverse into a bull trend without going sideways. Bears want the low one. They're hoping bear trend, bear flag, and we go down. Not a good sell signal bar, 31. Still a double top bear flag, 26. But you're selling in the bottom half of a trading range, and you're selling below a bull bar. So not a good stop entry trade. What about selling below 32? It's certainly better than selling below 31, but why were the bears not able to create a better looking sell setup? So that will reduce the number of traders willing to sell below 32. And did bulls buy the 31 low? I would not. I still think we have a magnet down there at that 60-minute moving average. Easy to get frustrated, right? But you shouldn't. That's just your radar telling you that you think the market is going sideways and that it's not going to go very far up or down. And so it's good to not worry about taking trades when the market's doing this. This is not a good stop entry market. There are some winners, but lots of losers. It's easy in hindsight to say, well, I could have sold below 21 and scalped out with 1 point, but you probably were trying to get 2 points because of the size of the bar. 1 point's not enough, and you would have ended up losing money or getting out around break even. Some of them work above 19, below 24, above 29, but a lot of them do not, and it's really difficult if you're trading with stops to end up with a profit. Limit order traders are doing fine. They sell bull closes, buy bear closes near the bottom, sell bull closes near the top, and then they buy below prior lows, like below 12. They'll buy below 28. They'll buy below 16. They sold above 10. They sold above 18. They sold above 22, above 21. But this is a terrible location to do anything other than maybe limit order trades. We've spent a lot of bars at this price right in the middle of the range. 15-minute Globex chart. Here we have a nice looking bull bar for a double bottom pullback. So we have a double bottom pullback. The buy triggered by going above that very good looking bull bar. But look, it looks like we may go upside down. So, and that's a big loss. The bar is pretty big. So incredible buy setup, but for the bears, it's a bear flag, bear trend, low 1, low 2, and this is a pullback in what the bears see as a bear trend. Can you sell on a stop below 28, below 16? If we go below 28, we'll probably go below 16, but then 16 you're selling right above the 60-minute moving average, which is a target, and you're selling at the bottom of a trading range. So I think it's not worth selling at the low and not worth buying at the high. Bulls hoping for another reversal. We have a double bottom, a higher low. The bulls want another higher low. They want a double bottom, higher low here. Bears have a double top bear flag here. Bulls trying to get as good a bull bar as they can. They'd like to get a double bottom and another higher low. And the bears want bulls to give up. The bears want to start getting bear bars closing on or near their lows. Higher low 16, higher low 28, and then higher low 33, 34, and possible micro double bottom. Can the bulls get 34 to close on its high? That will attract more bulls willing to buy. You can call it a triangle. We have higher lows, we have lower high. We already know we're in breakout mode. We've been in a trading range for 2 hours. Suppose the bulls get a bull bar closing on its high. It's a credible swing buy. I wouldn't buy for a scalp in the middle of a tight trading range right below the moving average. And I'm personally deciding what to do with it. When in doubt, I stay out. So I'm probably not going to buy above 34. They're at the apex of a triangle. The general rule is 50% chance the breakout attempt will succeed, 50% chance it'll fail, and 50% is not high enough probability if you're scalping. So if you're buying about 34 for a scalp, I would not do it. And for the bears, are you going to sell below 34? Probably not. If you get an IOI, inside bar 35, and a bear bar, that's a possible sell. Everybody wants a breakout, and I don't care the direction of the breakout. I want to break out. This is terrible location in the middle of a trading range, apex of a triangle. It's just a terrible location to enter with stops. In fact, at the apex of a triangle, it's usually not worth entering with limit orders either. Outside up 34, if we get outside down 35, then we have an OO, and it would be a breakout move pattern with buyers above 35, sellers below 35. Bears will be satisfied with 35 closing on its low for a bear flag below the moving average. If it goes OOO, that would increase the probability if you sell below 35. But if 35 simply closes near its low, it's a credible sell to get us down there. We're getting near the end of the third hour, bar 36. I said I would not buy above 34. Will I sell below 35? I don't know. If it closes on its low, I might. Looking for a new low of the day. On the 60-minute chart, the second hour is an inside bar, and the third hour is an additional inside bar. So 60-minute chart, we have an II, and you sometimes hear me say that an II is a triangle on a smaller time frame chart. We have an II on the 60-minute chart, and we have a triangle on the 5-minute chart. Lower high, higher low, higher low, higher low. So we're constricting. Some people don't distinguish between triangles and wedges. Some people call all of them triangles. Other people call all of them wedges. I usually use the term triangle if it's mostly horizontal, and a wedge if it goes up or down. So this would be a wedge, 1, 2, 3. So it's tilted down. This would be a wedge tilted up, 1, 2, 3, 4. Triangles, 50-50 chance. You'll get a breakout to the upside, 50-50 chance to the downside, 50-50 chance the first breakout up or down reverses. In a wedge, they more often are reversal patterns, especially if the shape is good. So if you have a wedge going up, you look for a reversal down. And that's in part because a wedge is a bull channel. A wedge up is a bull channel. A bull channel is a bear flag. You typically get a breakout below the bottom. And a wedge going down is a bear channel, and a bear channel is a bull flag. So if you have a bear channel, you expect a bull breakout. Bulls still on the buy above 34, trying to get above the moving average, trying to get above a lower high, 31. They would like to get a big bull surprise bar. We're at the end of the third hour, and we have an OO breakout mode pattern. It would be better for the bulls to have a bull body on this third hour. The hour opened with bar 25. So for the hour to have a bull body, 36 has to close above the open of 25. So the bulls are trying to get 36 to close above that red line, the open of the hour. And the bears want a bear body. We have an OO. A bear body makes it slightly more bearish, increases the chances of a bear breakout, especially if the bear bar closes on its low. This is not going to close on its low. A bull bar makes it slightly more likely that we'll get a bull breakout, especially if the bar closes on its high. It's not going to close on its high. That's OO. I want II. I've been calling it OO. Outside bars. Outside bars, if you have consecutive outside bars like we had on the 15-minute Globex chart, it's a triangle on a smaller time frame chart. So there's a 60-minute OO, and if you go to the 5-minute chart, it's a triangle. And II is the opposite. It's a contracting triangle on a smaller time frame chart. So consecutive inside bars, if you look at a smaller time frame, it's usually a triangle. And here we get the bull breakout. we're trying to get, well, we don't, on the 60-minute chart, this is just the end of the 60-minute bar, and the bulls will try to get the breakout above the high of the third hour, which is right now the 25 high. So in the fourth hour, after 9:30, the bulls want to break above 25, and the bears want to break below the low of the hour, 28. Is it by the close yet? Not yet. The bulls probably need consecutive bull bars closing on their highs. We've been paying a lot of attention to the moving average all day. Resistance, support, resistance. Not a great bar for the bulls, right? Close above the moving average, but a tail. And still think apex of a triangle. Lower highs, higher lows, so still in breakout mode. Is it more bullish than bearish? I think the bears did not flip it to always in short 25 because of the lack of follow through 26. So I still think we're always in long from 18. So it's still slightly more bullish, but it would not be at the apex of a triangle. If it was 60% bullish, it's more like 52% better for the bulls, 53% for the bulls. But if we start to get bull bars here, it'll become 50, 60%, 60% or better for the bulls. Bears want double top 31. Remember I said earlier that sometimes you get a sell climax in a trading range, and the trading range lasts all day. Big sell-off, reversal, but trading range. Big sell-off, trading range. Big sell-off, possible trading range all day. It's not what most traders want. Limit order traders are perfectly happy with that because they make an incredible amount of money. But if you're looking for stop entries, it's frustrating. You keep getting entries that do not get very far. I'm going to rest my voice. I'm starting to get a sore throat from talking, and we'll type until around 11:30 or so. Okay, I'm back. We have a wedge with 548, but with the 4 bear bars, it's not a very convincing buy. What's happening here is we're testing the 60-minute moving average in a bull trend, and there probably are more buyers than sellers here. So I still think we're going up to 3,000. The bears are trying to get an outside down day, but what often happens when the market tries to go outside down is it gets very close to outside down. This is yesterday's low, but instead of going outside down, it reverses up, and it can reverse up sharply. Big sell-off, yesterday's high, yesterday's low, and we got almost outside down, and the bulls bought, reversed up very strongly. And this is an example. This is not outside down day, but it's a day that went to a new high and tried to go to a new low and reversed up sharply right above the old low. Here's an outside down attempt above yesterday's high, reversed down, could not get below yesterday's low, reversed up. Testing any prior low, you can get a reversal from right above the low. Another example of almost outside down, sold off for 4 hours and then reversed up the remainder of the day. This is one of those midday reversals. It's probably around bar 40, bar 41. There are 81 bars in the day. You often get wedge reversals at around 41 bars, 40, 41 bars. Here's another midday reversal. Reversed down from yesterday's high, tried twice to break above it. We got a double top lower high, and we collapsed in the sell climax, but the bulls bought right above yesterday's low, so it's almost outside down. And when you get the reversal, you very often get a swing up for the rest of the day. Sell off, reversed up from just above yesterday's low. We were above yesterday's high all day and broke below it, almost got below yesterday's low and reversed up. Another example, sometimes it gets right down to the low and hits yesterday's low and reverses up. Some other examples here, a perfect test of yesterday's low, tried twice to get below it, could not. And then we have a bull bar, bulls bought the reversal up. And we're not quite at yesterday's low, and we do not have a good buy signal bar 58. The bears low 160 after not a very good buy signal bar, so it's a credible low one. But you know, when you have smaller bars and tails, you got to be thinking it might be a limit order market like we had here. You can see the market often does things right around the middle of the day. Here we had an III, we broke to the downside. It failed. We broke to the upside. It failed. And then we broke to the downside again. That made it a higher probability sell. And we got a bear surprise bar and a spike and then a parabolic channel down. The bulls, a lower low major trend reversal, but 4 bear bars, probably minor. It's also a wedge, 1, 2, 3, and almost a perfect leg 1, leg 2, leg 1, pull back, and then leg 2. Too many lines on the screen, so let me get rid of some of that. What do you do right here? I'm currently flat. You know, I'm happy to buy, but I want a better buy signal bar. And I'm happy to sell. Maybe if we're lucky, we'll get a pullback to the moving average and a decent sell signal bar for low 2, low 1, and then low 2, and then maybe one more leg down, 1, 2, and then 3. And bears are hoping for outside down. And daily chart, yesterday was outside up, below the low of the day before, above the high day before. Today we went above yesterday's high, and we're trying to go below yesterday's low. Are we always in long or short? I don't think that we ever became clearly always in long here. Also, the first reversal up after a pretty good sell-off is typically minor, and this has the potential to be major, but 4 decent bear bars, that's not going to attract a lot of buyers. So what do? You wait for more information. You wait for maybe a low 2 bear flag at the 2 moving averages, or you wait for an upside breakout. I don't think we're going much lower. It's possible this ends up as the low of the day. Perfect breakout test, 55 testing, 16 low. So might get a measured move down. Gets us closer to yesterday's low. There are 2 pink lines down there. The higher of the 2 is yesterday's low, and then the lower of the 2 is a gap. You can see on the daily chart, we gapped up over here. We tested into the gap here, but this low did not go above that high, so the gap is still open, and it's the space between those 2 lines. Bears trying to get a low 2, 60 low 1, 63 low 2, and then a break below yesterday's low, which would be, I think, pretty interesting because 00 patterns on the daily chart are pretty unusual. Here's the daily chart. Here's today, here's yesterday. So even if it's an 00, it's so tiny that I don't think it's all that significant. There's not much energy there. It still looks like we have to get up to the 3 moving averages and 3,000 big round number, but we have a credible top already. We have a wedge, and now we have a double top with the wedge. So the bears they have what they need to create a reversal down. Now, why is the stock market going up when we had such a huge sell-off in February, March? It's going up because, in simple terms, there are more buyers than sellers, and you never know the reason why. One reason is down 35%, and a lot of traders said, wow, how often do you get a chance to buy a 30% discount? So you got a lot of value traders buying there. And then you got the actions of the Fed. The Fed is doing things that it has never done before, but the message that the market is hearing is that the Fed is going to prevent a collapse of the market, and that the Fed they have said that they will print infinite money to protect the market. So that's making bulls feel pretty safe that if the market starts to sell off again, the Fed will buy, and the market cannot fall too far. I said the Fed prints infinite money. That's the terminology that Fed governors have used, that we're going to print infinite money. But the Fed doesn't print money. The Treasury prints money. However, the Fed can still effectively create money. So we can tell a bank, we'll buy a bunch of your bonds, any kind of debt. We'll buy any securities that you have. And since we cannot print money, and since we probably don't have money, we're not going to give you money, but what we'll do is we'll give you credit. So if you want to get stuff from us, sorry. This is we had something like this the other day where we had a wedge with very big bars, and bulls hoping to get a decent buy signal bar 64, a bull bar closing on its high and not getting too big. This is similar to what we had. This is kind of like that. Not great for stop entry traders. And then we had it over here as well. Really tough for stop entry traders. Big bars, so big risk, and lots of reversals, so lower probability. But if 64 closes near as high and does not get any bigger, it would be a credible buy. And you could argue it's a nested wedge, 1, 2, 3, and then 4, or you could say 1, 2, 3 within a bigger wedge with bar 5. So it's multiple reversals. And for the bears, they're trying to get outside down, and they need to get below the upper of the 2 pink lines, yesterday's low. It's tough to short, right? A lot of two-sided trading, and the correct instinct is when you see a lot of reversals and the market's low, it's better to be looking to buy. If you see a lot of reversals and the market's high, it's better to be looking to sell. I ended up not selling below 55 because of the 8-bar bull microchannel. I thought we'd dip below the 48 high and try to form a major trend reversal. And we did try to form the major trend reversal, 58, but 4 bear bars. So traders want a second buy. 61 is a second buy, but it's also a bear bar, so not a lot of buyers buying that. And then 64, it's a doji bar, so it's just not good stop entry trading. And not good for the bulls to buy above 58, 62, 64, and not good for the bears to sell below 60, 62, 64. The market is simply deciding, are we going to go upside down? Are we going to, which is, I think, pretty interesting because it's rare on the daily chart to get consecutive outside bars. If we get it, it creates an interesting situation because 00 is breakout mode, and that means it's a sell signal below today's low and a buy signal above today's high. So I want to buy, but I'm not going to buy above a doji in a tight trading range right below 2 moving averages. So right now I'm trapped out. A few minutes ago, I was just on the phone with one of my daughters. I have 3 daughters and 2 stepsons, and 2 of my daughters are identical twins. And today was their birthday, the 31st birthday. So it was nice to talk to them. One of the funny things that their husbands joke about is that one of the husbands works at Apple, the other one works at Google. They're both PhD software engineers, and they make a lot of money. But one of them jokes all the time that he's the only guy at Google whose wife makes more than he does, which is pretty funny. My daughter. Oh, my stupid Pixel phone. That daughter, the one who's married to the Google engineer, she has her MBA from Harvard, so she's doing well. And her identical twin sister has a law degree from Stanford, so she's a San Francisco lawyer. They're both doing very well. Well, I want to be long, but I did not buy. We're low in a trading range day. It's a trending trading range day. We got a trading range breakout, trading range. It's also a bear trend resumption, bear trend trading range. It's also leg 1, leg 2. And I think most importantly is what I said on the open. It's a test of the 60-minute moving average. Here we touched the moving average just a little bit. Here we got close to it, but did not touch it. And when that happens and you start to get near it again, a high percentage of the time, like 80% of the time, you're going to dip below the moving average the next time you get near it. So the bulls held above it for 3 bars here, and they were unable to keep it above. And you can view this as a wedge bull flag, 3 or 4 pushers down, 1, 2, 3. So a higher low and a wedge bull flag, magnet above the April high. If we get above that, this is the 60-minute chart, but if we get above it, it triggers a buy signal on the monthly chart. And I still think we're probably going to go up above the April high, trigger the monthly buy signal, get up to 3,000, test the 3 moving averages on the daily chart right there, around 3,000, and fail, and then turn down maybe to this low. I think we're going to close this gap, which is just above 2,600. So I think sometime in May or June, at this point, probably June, we'll come down here. And that's why I am short. I shorted by buying SDS, which is an inverse ETF of the E-mini. And I will buy more if we get up around 3,000. I'm long other things, right? So, but right now, as far as the stock market overall goes, I think the odds are we're coming down here sometime in the next couple of months. So that's why I'm short. Again, in terms of terminology, I'm short the stock market, but that does not mean I'm short stocks. They have ETFs, which are inverse versions of the stock market. So you buy the ETF, and it's the same as, or very close to the same as, shorting the E-minis or shorting the spider. Bear is trying to get a double top bear flag at the moving average, and we did not get a good buy signal bar 64, bears will try to get a good sell signal bar, 66. What's a good sell signal bar? Well, a reasonable sized body, a bar that looks kind of like 56, but put it over here. So a decent sized body closing near its low. If the bears get that, traders will sell double top, and they'll try to get below yesterday's low. I talked about the outside down, almost outside down, and you get the reversal up. But typically, you get a good bull bar closing near its high. And, you want to see bull bars closing near their highs to buy. This is not all that good. But then you get 3 or 4 bull bars and traders start to buy. Bull bar, decent sized body closing near its high. 2 more bull bars, another bull bar. So buy the close in here. So that's what the bulls would like, but that's not what they're getting. So you have to wonder, have we finished going down, especially when there is, I think, an important magnet below yesterday's low. This was a fair price for 4 hours, or 3 hours, so we may come back there to the middle of the day, especially since I think that we have to get up to 3,000 before we can go down to 2,600. And therefore, anytime you see anything bearish intraday, 5-minute chart, chances are it's not going to be the start of the move down to 2,600 on the daily chart. All right, so can the bears get a decent sell signal bar? Can they get the bar to close below the moving average, close on the low of the bar? And for the bulls, we're not getting good buy signal bars anywhere in here, and we're stalling at the moving average. So not a lot of traders willing to buy at the high of the leg up. Borderline, I had my finger on the button to sell below 56. Well, the tail is just a little bit bigger than I want. The body is a little bit smaller than I want, so I did not take the sell. Tight trading range, so bad context for a trend. You can see here, tight trading range. It kept trying to go up and down, up and down, up and down, and it took forever to get a trend. We're in a similar situation here, and not good for stop entry traders. A lot of traders are trading with limit orders, and they're scalping. And so they're going for 1 point, 2 point, 1 point, 2 points, not big profit. Most traders should just be flat. Can you be long above 64, taking a chance that we get up here? The reward offsets the low probability. So you buy above 64, stop down here, so you're risking about 5 points or so and hoping to make 15 points. So the reward is 3 times the risk, and the probability might be 40%, so the math is okay. I'm going to wait for a better stop entry buy or a better stop entry sell. The market still has not yet decided whether it's going to go upside down. You can see every couple of bars it changes direction. So you see a bull bar 65 and you get hopeful that we're going to go up. You see a bear bar 66 and you get hopeful that we're going to go down. But we're not. We're going to keep reversing almost every couple of bars. We're changing direction. Sometimes the market waits until the final 30 minutes to do whatever it was planning to do. And the 2 choices are go below yesterday's low or come back up into the upper trading range. And we're pretty much right in the middle of both. So here's the middle of the upper range, and there's around where we are, and that is an equal distance move down just below yesterday's low. That happens a lot, that you're in breakout mode when they're right in the middle of a target above and a target below. Breakout mode means 50-50 up, 50-50 down, and the target above, target below means the reward for the bulls is the same as the reward for the bears, so very neutral. Profit, the same, bulls and bears. Probability, same, bulls and bears. You can call this another attempt at a double bottom pullback. We have a double bottom here, slightly lower low, a reversal up 65 and a pullback 67. But the bulls want a good buy signal. If they're going to be buying with the stop 68, they want the bar to close on its high at or above the moving average. And for the bears, what they have is a small expanding triangle. Well, the bulls have an expanding triangle as well. Up, down, up, down, up. So breakout mode, theoretically, buyers above 66 and sellers below 63. But there's no way that I'm buying on a stop up here or selling on a stop there. I don't want to be selling at the bottom of a tight trading range or buying at the top. I like to buy a reversal up, but I want a good looking bull bar near the bottom and did not get that 58, 61, 64. And I like selling a reversal down from the top, but not good sell signal bars, 60, 62, and 66 is borderline. I chose not to take it. I wanted it just to be a little bit better. Will the bulls get the bar to close near its high or not? And if they do, it's a credible buy. You got a double bottom, a breakout, and a pullback. So you can view this as an early bull trend and this as a bull flag in this bull trend. But because you're buying at the top of a tight trading range, you need 68 to be perfect. And if it's not perfect, I would not buy with the stop at the top. For the bears, they're still on their sell. If that's not good enough for me to buy. So the bears are still on their sell 66, taking a chance that we go below yesterday's low. Bears trying to get a bear surprise bar, and they hope the breakout leads to a move down to yesterday's low. But we're at the bottom half of a tight trading range, and this is not a high probability sell. You know, it's the opposite of 65. A good bull bar, but look what happened afterwards. Do we go up? Nope, we reverse down. So trading ranges, tight trading ranges especially, are always trying to get you to sell at the bottom, and they always try to get you to buy at the top. And better just to fight it. You know, just don't do it. And you know, at some point, one of the trades is going to be successful. And then you look back and say, darn, that was really the one I wanted to take. I would have taken that one. But the truth is, you would have taken 5 of the other reversal attempts as well, and you would have been so far down that catching the one good trade would not erase all of your losses. Remember, you got to be doing this to make money. And, you know, you cannot be doing things that are destructive and being hopeful. You know, buying high, selling low, that's destructive behavior. It's better to wait until you see the breakout and then place trades. If the breakout has good follow through like this, you can sell, expecting it to go at least a little bit more down. If it has bad follow through like that, you know, you get out of longs and you might sell. On a day like this, it's mostly scalping, right? You know, how many swing trades did we have between bar 5 and bar 42, right? You know, maybe a brief one here, and that was it. So on a day like this, it's better to go in planning to take quick profits. If you can get a couple points, you know, as many times as possible, you know, you'll end up with an okay day. Is it sell or close? Nope. What did we do at this price earlier today? Look to the left. They bought it, they bought it, they bought it, they bought it. So you want to sell here and expect that the market's going to behave differently this time. You know, it's probably always in short. We've been below the moving average. Maybe we went a little bit always in long here, probably back to always in short here. So we're still on the trade down from here, and we have a magnet below. But I think difficult to structure a trade, and I'm not going to be selling with the stop below the low of the range, even though even if the probability is that we're going lower, and it is. Can you sell? It depends. Do you want to risk up here? Do you want to risk 10 points to make? How many points do you think you'll make? You know, 2 points, 4 points, risking 10 points. It's not worth it. You have to be right 70 or 80% of the time. And this is not 80% certain that we're going down. You know, it might be 55% certain, and that's not good enough to risk 10 points to make probably no more than 4 or 5 points. Why are we bouncing here? Because of what I said. We're near the bottom of a tight trading range. And anytime you have a big bull bar closing near its high, there will be a lot of bears selling the close. Anytime you get a big bear bar closing near the low of the bar and low of the trading range, as soon as you see that, a lot of bulls will just hit, boom, buy the market and look for a scalp. So they buy the close, and it has to go up 9 ticks from their entry price to make 2 points, which is just about where it is right now. Stop order bulls are hoping that we're going to reverse up again. We reversed several times here, and they're hoping that 70 is the opposite of 20. Breakout and then reversal, and here we get a bear breakout and a bulls one reversal. It's a credible buy above 70 if it closes near its high. You know, you're risking several points and you're hoping to make maybe 10 points. You know, it's kind of the opposite here. If you sold below 21, you know, you had to sit, you'd probably get stopped out, and then you sell again below 24. Or you could use a wider stop and hold short. This is the opposite. A big bear bar, a bear breakout, but a lot of trading range price action, and that makes it a low probability bet. Now, I said earlier that very often the market will get almost upside down and then reverse up violently. And that we can still get a violent reversal. And sometimes you get it right at the end of the day. I don't know if I have any examples right at the end of the day. Yeah, we broke below yesterday's low at the end of the day. We got a little bit of a bounce. Getting fairly late in the day, and the bulls reversed up pretty sharply. Late in the day, almost upside down, bounced for a few bars. So we can still get right down to yesterday's low and get a reversal up. At this point, if we do get a reversal, we're running out of time. It's probably not going to be much of a reversal at this point. I don't think we'll get back here. Can we get a big bear trend from here? Probably not, because what's the goal of the bears? They obviously want a big bear trend, but realistically, what are they trying to do? They're simply trying to get 1 tick below yesterday's low. So there's not a lot of incentive for them to sell below yesterday's low. They just want to get it there so that everyone will say, wow, upside down day. And smart people will say, well, yesterday's an outside up day and today's an outside down day. So that is even a better bar going into tomorrow. Remember, OO, it's a breakout mode bar. You sell below, you buy above on the daily chart. Can you buy at the market and put a stop 1 tick below yesterday's low? That's one of those, I think, interesting math situations. You know, you sell, you buy at the market, and your stop is maybe a point below. So you're risking 1 point, and you're looking for a 10-point bounce. So you can say, wow, the reward is 10 times greater than the risk. What a trade. That's a great trade. But whenever you have a great risk reward, you're going to lose money a very high percentage of the time, right? You cannot have good probability if you have good risk reward. So if the reward is many times greater than the risk, then you're probably going to lose. It could still be a profitable strategy. You could lose 90% of the time and still make money if you take the trade 100 times. If the reward is so big on your 10 winners that it offsets all the little losses. So, for example, if you lose 10 points 90% of the time, you lose 90 points after 100 trades. But let's say you make 20 points on the 10 wins, you make 200 points. So you make more than what you lose. But I don't want to lose 90% of the time, and therefore I would not buy the close of 70. If we get a reversal up 71, especially from just above yesterday's low, the higher of the 2 pink lines, I would take that. I would buy that. You put a limit order to buy 1 or 2 ticks above yesterday's low and put a stop 1 tick below so that you're only risking 3 ticks or so. again, if you're only risking 3 ticks on a trade and you're trying to make 10 or 15, 20 points, odds are better than 90%, you're going to lose. So, and it's not fun to lose. Even if you make money on 100, if you're taking the trade 100 times, you're losing 90% of the time. And emotionally, it's not worth it. It's destructive. You got to be happy as a trader. And I don't think you can be happy making money if you lose 90% of the time. Okay, we just went below yesterday's low, the higher of the 2 pink lines. And the lower of the 2 pink lines is that gap on the daily chart. We gapped up on Friday, and we're testing that gap, trying to close that gap right now. The bars on the daily chart are so small, they're not particularly meaningful. Here, we had an island bottom, and it was the start of the big rally. And some bears are hoping that we don't close the gap and we gap down tomorrow, and then we have a 3-day island top, and maybe it'll be the start of the swing down. We'll see. For me, an island top simply means you have a gap up and then a gap down, and the gaps do not have to be exactly sideways like this. They can be at different levels. So obviously, an island bottom, gap down, gap up, and you can see right through all the way across. But this is an island top, and this is an island top as well. Gap up, gap down, here gap up, gap down. I would call this an island bottom. We have a gap down, we have a gap up here. That gap closed, and we have another gap here. So we have a gap down here, gap up here. So even though you cannot draw a line through it without hitting bars, to me it's an island bottom. I would call this an island bottom. Gap down, gap up, gap down, another gap up, another gap up. So you can say gap down, gap up. This whole thing is a big island bottom. This whole thing is a big island top. Gap up, gap down. Here's a small island bottom, a bigger island bottom, gap down. Maybe that's a gap up. I don't know. As you can tell, I'm very flexible about everything in trading because the market, it's really, I think of it as kind of like molten plastic. So, shapes are not perfect. Everything is kind of like Salvador Dali painted it. Everything is just kind of melted. And daily Globex chart, look at this. We went above the Globex low and above the Globex high and now below the Globex low. That happens about 10% of the time. Is it sell to close down here? I don't know. Theoretically it is if 71 closes on its low, but I don't know how much lower we'll go. We've already achieved the goal. We've formed an outside down day after an outside up day, and now on the daily chart we have an OO pattern. Okay, so it's sell to close, but very often when you go below yesterday's low or below any support, you get buyers and a bounce. So this is not great sell to close. How much lower can we go? Well, 60-minute chart, we have a wedge rally, not perfect, but a wedge rally and a double top. The bears want to get down to the neckline of the double top. So double top and neckline, and then they want to go down for a measured move, which would take us to around 2,600, which is where I think we're going to be at some point in May or June. Now, can you buy above a bull bar 72? Failed breakout low of yesterday. With those 3 bear bars, I would not. I think bears get out of shorts above 72, and bulls wait for a micro double bottom. When you get outside down days, usually the market does not fall far below yesterday's low. Sometimes, early in the day, you can get outside down. Here's yesterday's high, yesterday's low, and we fell for more than a measured move. So if you get it early, and if yesterday's range was not big, you can get a huge trend below yesterday's low. but more often you get a little bit above yesterday's high, a little bit below yesterday's low. Usually you go below yesterday's low by about the same amount that you went above yesterday's high. Symmetry. Above yesterday's low, high, below yesterday's low, about the same amount both ways. Struggled to go lower. They bought in the final few bars of the day, and that's something that could happen today. The amount above yesterday's high is about the same as the amount below yesterday's low. So lots of outside down days, but most of them you do not end up far below yesterday's low. Again, profit taking, all right, at the end of the day, back to the middle of the range. This is easier for the bulls. It's a second reversal up, first and second, and a decent bull bar. We do not have this today. Late in the day, first reversal, second reversal, higher probability of a bounce. Just a little bit below yesterday's low, and then some profit taking. Bulls buy above a bull bar closing near its high. Same thing late in the day. Not a good looking buy signal bar 72. Do bears still have to get out above 72? Well, a couple things they could do. One is they could get out, or they could get out 4 ticks, 6 ticks, or 8 ticks above 72 bull bar. And can the bulls buy? Nope. If 73 closes on its high, then maybe you'll get some bulls buying. I don't want too many lines on the chart, so let me get rid of that one from the gap. Now, bears, it's a low one. 72 is a pullback in a bear trend, so theoretically it's a sell below 72. And 73 has a higher low, also a pullback, so theoretically a sell below 73. But look what we're doing. We reached an obvious important target, and we're stopping. And if we were to go a lot lower, why would we be stopping at important support? You know, that's a sign that if we go lower, we may only go a couple bars lower, not much lower. And for the bulls, as I said, they're happy to buy. They want to buy, but they want to buy above a bull bar closing on its high, not above a doji 72. Maybe they'll get an inside bar 73 closing on its high. And for the bears, it's still sell the close, but sell the close bears 71, disappointed 72, and that's why we bounced 73. You have the bears who sold the 71 close, and they saw 72, and they said, darn, I was hoping we'd get another bear bar, maybe late in the day, maybe I should just place a limit order to get out around my entry price on around the 71 close. So that caused part of that bounce, 73. This is, I think, I'm pretty much fascinated by the OO on the daily chart because you usually do not get them. It's pretty unusual. How far down can we go? As I said, when you get an outside down day, especially late in the day, you typically don't go all that far down. So I think we're probably going to get some short covering by the end of the day. So I think we're going to get a bounce. So also doji 72, pretty big tail 73. That also increases the chances that we'll get some profit taking, some kind of a bounce late in the day. So not really good sell to close. We have basically a sell to close bear trend starting bar 66, and it became clear on 70. And it's starting relatively early, at noon, but when you're in a bear trend, it can start at any time, even 11 o'clock, and make it until the end of the day. So even though we now have about 10 bars in the sell-off, because it's a bear trend day, the sell to close trend can last all the way to the end of the day. I've mentioned that I'm currently short I bought SDS. This is the E-mini. And this is the SDS. And let me just take a look at my position. I'm down a little bit right now. I'm down about 20 cents. And I'm hoping that we come up here at a minimum $26. So that would be about, I don't know, $2.50 profit. And with any luck, we'll go higher. Maybe we'll come up to this breakout point, $29. We'll see. And obviously, the people that put on television are always saying buy, buy, buy. But I think we're going up to 2,600. I just don't know if we're going to get to these targets first. This lower high and these three moving averages. And that's why, I sell or get short. I buy SDS or QID or some kind of inverse ETF. There are lots of choices. Another obvious one is FAZ. That's an inverse financial ETF. So it's basically like the XLF, but 3 times the leverage. And you can see today it's up 7%. A lot of the banks are selling off. All the banks are selling off. Here's Bank of America, a bull flag. We're breaking below the bull trend line. JP Morgan, same thing. You can call it a triangle or a bull flag, bear flag. We're breaking below. So it makes sense that the XLF would be starting to turn down, and that the FAZ, the upside down 3 times the leverage, would be starting to turn up. For me, end of the day, I'm not going to trade this. I'm tired. I took a lot of trades today, and end of the day, I get tired, and then we get tails 72, 73, 74. It starts to lower the probability, so I'm going to let it go. And on the daily chart, you often hear people on television say picking tops and bottoms is really difficult. But knowing that the market is probably going to top is a lot easier. And on the weekly chart, I've been saying that we would get a V bottom, but that it would not go up to a new high. We had a V bottom here, went up a few bars, weekly chart. We had a V bottom here. It did go to a new high. And I said that I thought we would not get to a new high. I thought we'd get to the moving average, but I wasn't sure how much higher we would go. But I'm still very confident that this is not going to go up to the high, and that we're going to enter a trading range, maybe 2,600 to 3,000. So I'm getting short near what I think is the top of the range, expecting to move down to 2,600 or so. Might go up a little bit more. What happens if it just keeps going up? Well, I'll lose. Nothing is absolutely certain. So sometimes I lose, sometimes I win. You just want the number of wins greater than the number of losses if you can do that. And at a minimum, you want the size of the wins significantly bigger than the size of the losses. And I think that is really important. So we're just collapsing down here. This is another low. It's the low of that day. What happened to the weekly chart buy signal? So on the weekly chart, last week is a bull inside bar, a high one, bull bar closing on its high and a strong bull trend. But it follows 2 dojis, and those dojis are a sign that the bulls are losing momentum, and it's also right at this weekly moving average. So we went up above it and down, and last week we went up above it, and we're turning below it again this week. So we're getting a micro double top at the at the weekly moving average, and maybe we'll fall for a measured move. So that's the neckline of the double top, and measured move gets us close to 2,600, but I think we're going down to 2,600, so I think we'll fall for more than that. as I said, we might go a little higher first, but I think at some point in the next, May or June, we'll be down at 2,600. So what's the news? Why are we selling off? I don't care. I never care. All I care about is more institutional dollars think the market is too expensive than institutional dollars that think it's cheap. So when I look at this, it's it's going down. So I want to be short. I'm currently flat with the E-mini, but I'm short on the daily chart. I mean, it's really, okay, this is the biggest bear bar of the day occurring late in the bear trend. So there's zero, even if this was earlier in the day, there's zero chance I would sell it. I want to talk a little bit about the coronavirus thing. Okay. If you think about it, we might have 20% unemployment. So basically 20%, a fifth of the economy is wiped out. Yet we're all, look at the NASDAQ. So a fifth of the economy is wiped out, and the NASDAQ is almost up to a new all-time high. And S&P is, very high up off the low. How can that possibly be? How can you lose 20% of all your workers and all the consumer spending and rally like this 40%, 35%? Because the market is looking at many variables, and the unemployment and the depression level type of GDP that we're going to get are important, but there are other things as well. And the single most important thing is the Fed. There's a saying on Wall Street, don't fight the Fed. And the Fed has said they're not going to let the market get destroyed. They're not going to let the economy get destroyed. They will print infinite money so that, and they're buying stuff. They're not legally allowed to buy ETFs yet, although I think they can buy bond ETFs, but they cannot buy stock ETFs yet. And a lot of this rally is that everyone's thinking it can't go down. The Fed said they're not going to let bad things happen, and they're going to buy stuff. So a lot of this rally is based upon the dollars coming in from the Fed and traders, and institutions having confidence that we can't go lower. But just because we might not go down to 60% down, 50% down, does not mean we can't correct down 10 or 15% from where we are, and I think we will. So I think we'll come down here. And monthly chart, I've been saying forever that over here in late 2017, I said that was the most extreme buy climax in the history of the stock market. Never before have we had whatever that is, a 13-bar bull microchannel on the monthly chart. On the weekly chart, back in 2017, we had 63 days without touching the moving average. We got close here, but did not touch. Never in the history of the stock market did we go 63 days without touching the weekly moving average. And then on the daily chart, it was like 400 plus days without a 5% correction. That had never happened before. So on the daily, weekly, and monthly charts, the market had one form of the most extreme buy climax in history. And that's why I said back here that we were going to enter a trading range and it would last a long time. Trading range, you sometimes get new lows, sometimes get new highs, but you basically stay sideways. And look where we are. We're in the middle of a 2.5-year trading range. And I think we're going to stay sideways for the rest of the year. This may end up being the final high. I don't know. But I think we're going to get a big head and shoulders top monthly chart. So left shoulder, head, and then whatever rally we get will be the right shoulder. And I think we're going below this low at some point in the next few years. So I think we'll get down here, 1,700, 1,800. That would be about a 50% correction. Right now the high is 34. This would be 1,700. That's about 50%. I do think we're going above here. I do think we're going below there, both sometime in the next few years. But I think we're going to be in a trading range for the next 10 years. We're 2.5 years in the range right now. Trading ranges, you get new lows, you get new highs, new lows. So I expect we'll probably get a new high at some point in the next year or two, and I expect we'll get a new low. If we get a new low, then we're pretty close to what I think is the target, the bottom of this 2014, 2015 trading range. So I think that's where the market is headed at some point in the next few years. And this 2.5-year trading range, I think it's going to last a decade. So I think we'll be sideways for another 5 or 10 years, the whole, all the 2020s. What happens if I'm wrong and we go up to 4,000? I'll be wrong. If it's going up strongly, I'll buy. But right now, I think of all the things that can happen, a crash, a huge rally, trading range. I think this trading range will continue for the rest of the decade, like it did in the 1970s and in the 2000s. Okay, very climactic. Whenever you get the biggest bear bar late in the trend, 60% chance it's either the end of the trend or you go a little bit lower and that's the end of the trend. So I don't think there's much downside from here. Bar 77. Nowadays, the New York Stock Exchange releases data at the start of bar 77, and you often get a big move right at the start of bar 77. By the way, you cannot do this unless a whole bunch of stocks are going down. New York Stock Exchange has about 3,000 stocks. And to get a drop like this, you need a lot of stocks. We fell 40 points in an hour, right? So you need a lot of stocks going down. And so the ticks are always very negative when that happens. You can see ticks hit minus 1,000, the red line here. This is a 1-minute chart of the E-mini. This is a 1-minute chart of the ticks. And ticks hit minus 1,000, minus 1,000 again. That means 1,000 stocks more than went down than went up. So if IBM went down, you get a tick value of -1. If AT&T went up, you get a tick value of +1. And if you take all 3,000 stocks and you add up all the +1s, -1s, and zeros on the very last trade, the tick is based upon the most recent trade. That gives you your tick value. So when ticks are at -1,000, that means it's like 2,000 stocks went down, 1,000 went up, or 1,500 went down, and 500 went up, and then 1,000 went sideways. So, but it means a whole bunch of stocks are going down. So it's a broad sell-off. It's not just 2 stocks with bad news. Okay, this is the whole market selling off. But to me, I'm fascinated by the OO on the daily chart, and then on the weekly chart, we went up and down 2 weeks ago, and then last week we went up, and this week we're going down. So we're trading a micro double top at the 20-week moving average. At the end of the day, are we going to get profit taking? Probably not much if we do, right? This is a lot of bear bars. So when you get that, you might bounce for a couple bars, but you're probably not going to get a big bull trend out of it. I just looked at my short position, and I'm positive right now. I have a small profit. Buy the close, sell the close. I would not do any more selling. And if you're a computer and you're trading a small time frame, you could probably buy, but I think most traders should just wait for tomorrow. I'm flat. It's just not, math is not very good. The profit taking, if we get it, we can get like a couple big bars and 10-point plus bounce. But, it's not worth it. The math is just, your risk is big relative to your reward, and the probability is not all that high. It's really funny. Today I had a huge swing on my short position. I was down over here, not all that much, and then a day like this, I'm up. So we'll see what happens. Pretty fascinating day. I'm really fascinated by what's going on. We have, I think, a lot of things that for me are pleasing, that intellectually stimulating. The day started out pretty boring. We spent a lot of time, half the day, in a very tight range, and then another couple hours of it here. We, on the open, briefly went above yesterday's high and reversed down, and it ended up a bear trend from the open. Bar 1 was the high of the day, just like yesterday. Bar 1 was the low of the day. Here's the 15-minute chart. Yesterday, the first bar was the low. Today's the first bar was the high. Now, I want to put up the Globex 15-minute chart for a moment because I think it was interesting. I talked about this early on. I said, that's interesting. We had an outside down bar, an outside up bar, and then a third outside down bar. So we had an OOO pattern on the 15-minute Globex chart. This bar is the first bar of the day session. And I said, it's a credible sell. I did not sell below the low of the bar, but I thought it was interesting that here we were getting an OOO, 3 consecutive outside bars, which is pretty unusual. You know, that happens maybe 10% of the time. When you have an OO pattern, only 10% of the time do you get a third consecutive outside bar. And when it went above the high of the second bar, it triggered a buy. When the buy failed and went below the low of the second bar, it triggered a sell. Then it further triggered a sell below here. Back to the day session 5-minute chart. And this is the first half of the day, first 40 plus bars. And 1 and 2 consecutive bear bars were always in short, but fairly conspicuous tails. That reduces the chances that this is going to collapse. It increases the chances that we're going to get some trading range trading. Bar 3, it's an interesting bar, and I usually take that short. If you just went always in short and you get a bear inside bar closing on its low, closing at or just above the low of the prior bar, it's a fairly high probability short, at least for a scalp. I was talking, so I did not take the trade. And then 4, a surprise bar down, probably will get a couple legs down. And sometimes you get a big sell-off on the open and then a reversal up 6, and it's the low of the day, and you just trade up all day. Other times, it'll try to go up and then get 1 or 2 more legs down and then go up. And a lot of times when it goes up, you enter a trading range instead of a bull trend. When you have those 5 big bear bars closing with big bodies and some of them closing on their lows, you're probably not going to get a bull trend day. You can get a reversal back up to the high, but typically you don't get much more than that. So the best of bulls will probably get is a test back up to the open, yesterday's high of the day. So not a lot of upside potential. Sometimes you can get a spike in channel bear trend. So a spike, a pullback to the moving average, and then just a series of lower highs and lower lows all day. Here we got a sell climax in a trading range. That's another common pattern. And then you're in breakout mode. The bulls had a double bottom pullback, and they tried a couple times, could not go up. The bears had a head and shoulders top, left shoulder head, and then right shoulder. And we got a breakout 43. What was interesting over here at 40 was that 38 was an inside bar. 39 was a second inside bar. So now we have an II breakout mode pattern. And then 40 was a third consecutive inside bar. So now we have an III. Maybe 10% of the time when you have an II, it'll grow into a third like this. So it's breakout mode. We triggered the sell by going below the bottom of the bar 40. The stop theoretically is above the top of the II, or the top of the III, which is the 38 high. We went above the 38 high 42, and theoretically that triggers a buy, but we're also at the top of a tight trading range. I would rather see the breakout and then buy higher. And then, so we had a failed breakout below the low of the III, a failed breakout above the high, and then a surprise bar down 44. So we're probably going at least a little bit lower. I said on the open that yesterday, I thought this is really interesting. Here's one day, another day, 7 bars every day. And I said yesterday, we almost got to the 60-minute moving average. And if you're in a bull trend and you test down almost to support and then make a new high, and then you test down again to the same support, normally you fall at least a little bit below the support. That's why I said that I thought we were going to dip at least 1 tick below the 60-minute moving average. I thought we might do it right on the open with that big first hour down, and we did not. We went sideways and formed an IOI, in fact, an IOII. We had 2 consecutive inside bars on the 60-minute chart. But then I said we could get to the moving average by going sideways or down, and then we got a surprisingly big sell-off late in the day. So here, a breakout move pattern. We have bear breakout, bull breakout, and then a big bear breakout, 44. So we're probably going at least a little lower, and the minimum target is the 60-minute moving average. And then we have that big bar, 45, 46, and you look at that and say, oh, that's kind of a surprise. And we follow through bar 46, so we're getting a breakout. We have 2 consecutive bars closing below the 60-minute moving average and below the low of the day. So it might get a measured move down based upon the height of this trading range. And we obviously ended up far lower than that. For a while, we were at leg 1, leg 2, leg 1, pullback, and leg 2. So this is around leg 1, leg 2, sideways here for an hour, hour and a half or so. And then later we got the breakout. This is a spike pullback in a parabolic channel. We reversed up, and not a good looking buy. It's a failed breakout low of the day, and might be a trending trading range day, trading range breakout, trading range, which it was, but then we got a collapse at the end of the day. The rally here, tough to buy. I wanted a good buy signal bar 48. We have a better bar 49, but then a bear bar 50, so it doesn't look very good. We got back to both moving averages, and we're testing the bottom of the upper range. We have an outside down bar 55, but it's also an 8-bar bear microchannel, so it's a low probability sell. We fell to a new low, and for the bulls, a lower low major trend reversal. 4 bear bars, 3 of them pretty strong. It's probably not major, it's probably minor, so a trading range. Also, you can view it as a wedge with 7, 48, 58, but those 4 bear bars means we're probably going to go sideways. And we went sideways here, a lot of limit order trading. We have a little expanding triangle, up, down, up at the moving average, failing, moving average, moving average, moving average, but not a very good looking sell below 66. And then we got another pair of breakout bars, 69 and 70, and traders start to sell the close. The bulls trying to get a reversal up from yesterday's low, and instead we accelerated down, bodies getting bigger, and we ended up closing the day on the low. It's interesting how it ended up as a huge bear trend. One of the reasons why I often trade stocks and options on the daily chart is that you very often get these big trends at the end of the day, and I'm tired. I've been taking a lot of trades all through here, and I'm tired and resistant because I know I'm more likely to make mistakes. I'm more likely to read the chart wrong, to place orders incorrectly. And so a lot of times a trend like this at the end of the day, I don't take it, but it's a huge trend and I want to make money off it. And I do that by scaling into positions on the daily chart. And at the low, I do the opposite. I scale into longs. So that way there, I end up making a lot of money during the sell-off, but on my overnight positions, not on my day trading positions. For stop entry traders, it's pretty much 2 days. You got this and then this. A lot of bad stop order trading today. Theoretically, sell the close to the first stop order trade that I thought was worth considering was below 3. And 6 could have been the low of the day, but I did not like the tail on top of 6, top of 5, so I thought it was a minor reversal. And then the next stop order trade was 17, double bottom 5. Whenever you get a reversal from the low of the day, bar 16, and you get a bull bar, it's a credible buy, but you're buying high up in a tight trading range, so big risk and probability is not all that good buying right below the moving average. We got a bull breakout 20, and it could have been a move up to the high of the day, but then we got the bear bar 21, bad follow through. So the stop order traders sell below 3, buy above 6, maybe buy above 17 better, but still not very good, and sell below 21, not all that good because 20 is a bull surprise. We should get a second leg up, which we did, 23, 24, and then we have upside down 24, but not a big bar closing on its low. And we have a bear breakout 25, closed below the past 4 bars, but it might be simply a pullback from this. Bad follow through for the bears. So theoretically, a wedge bull flag, higher low 29, a double bottom, a pullback, a wedge, 3 legs down, 1 pause, 2 pause, 3. So possible low. Tail on top, not great. Entry bar 30, not particularly big, and then disappointment 31, 32. Looks like a tight trading range. The bulls have a double bottom, higher low 34, 28, micro double bottom 33, but tight trading range right at the moving average. I think most traders should not be trading with stops in here. And none of this was good stop order trading, except for if you understand the III. So theoretically, it's a sell below 39. I would not take it. And theoretically, it's a buy above 38, the highest of the 3 II bars. But I'd rather wait to see what 42 looks like and then buy above that. And then once we started to turn down, we had a failed bull breakout, a failed bear breakout, then it is a credible stop entry sell below 41, where you wait for the close of 43, a low 144, bull bar, not great. And then we broke the new low of the day, 45, closed below everything and closing at the 60-minute moving average, followed through 46, probably going at least a little bit lower. And that's all we did, is go a little bit lower. So it's sell to close 45, 46, 47. Bulls, bears who sold 47, disappointed 48. A lot of them tried to buy back their shorts around break even, below 49. Not a very strong stop entry buy, not a good stop entry sell. And when both buy and sell setups are bad, you're probably going to be sideways. So not good stop entry trading here. Expanding triangle, moving average, 66, but still a limit order type of market. And then another breakout, 69, 70. It's probably sell to close 70, definitely sell to close 71 if you have energy. And we just collapsed into the close. Limit order traders, there was a lot of limit order trading early on. Traders were buying every big bear close and selling every big bull close. They were selling above prior highs and buying below prior lows and scalping all through here. What about buying the 16 low? I would not, because of that. They'll break out below and above that III, and then a bear breakout here. So I would wait to see what we get. And it looks like it might be a trending trading range day, trading range breakout. So I don't want to be buying it below. And we never got back above that 16 low. We tested it, but we never got back above it. We tested it here, so a breakout test. That's good for the bears, but with a 7-bar bull micro channel, I thought we would go sideways and try to get a major trend reversal, and we tried, unable. They bought below 48, below 58. They sold above things. They sold above 62. Can you buy below 63? Well, it's a wedge, and we still have room to that. To yesterday's low, which is a magnet. So I would not buy. Also, this late in the day, I don't want to be buying with a limit order and then just sell the close into the finish. This is a really common type of situation where in the daily chart, you're expecting a reversal at any point. It could go higher, but you're expecting a reversal at any point. And when you get a collapse like this where it falls 50 points in an hour, it's just hard to sell it. It's hard to sell it and hold. It's hard to sell it and hold overnight. That's why I'd rather position myself on the daily chart, either with puts or put spreads or inverse ETFs. If I think that the market could go up forever, I don't want to be short stocks. I don't want to be long SDS or short stocks because the risk is too great. So if I think there's not a clear, strong top, I'll trade puts or put spreads if I'm going to be scaling in during a bull trend. If I think the market cannot go above a certain price and the price is not too far up, then I would rather trade ETFs like the SDS. And I did not think the rally would get above this high. I thought it probably would not get above this high. So I'm willing to be selling the market buying inverse ETFs in here. Usually I like to buy them on strong days or on rallies. I have a sore throat from talking. That happens all the time, even with the 2-hour break. But let me take a look at questions. Question, did you sell the 10 close at the moving average for the joy to see the bears making money there and then sell the next time the market gave the next sell signal at the moving average? I did not take that short, but if I were not talking, I'm very confident I would have taken that short. So on a day like tomorrow, when I'm not talking and I see that, I'm going to just hit the market, sell the market, and put a crazy wide stop and wait to see what we get. If it starts to go up, I'll get out. But I want to see both a breakout and follow through. So if I sold these closes, for example, I would not get out on 20. I'd want to see the follow through bar. And if 21 was a bull bar, I'd get out there. But I like that. Whenever you get a very strong sell-off and a pullback to the moving average for the big bull bar, I like to sell the close. And the opposite is true. If you get a very strong rally and a pullback to the moving average from the bear bar, I like to buy the close. Question, when there's a double top bear flag, is the bear flag more likely to succeed when the second leg up is a wedge or a biclimax? Okay. Yeah, in general, whenever you get a double top bear flag, any kind of a double top, the second leg is often either a biclimax or a wedge. And I personally am more willing to sell quickly if the second leg up is a wedge. If it's a biclimax, a lot of times I'll wait for a couple of bear bars before selling. But the second leg up often is very strong, a biclimax. Sorry, I'm having a hard time talking, so I may end up at some point having to take a longer break in the middle of the day or talk less. I talked a lot here starting around noon or so. So I have to pace myself because otherwise it's too painful. Okay, question, when sell the close bar 46, should I be looking for a scalp only? I'm always concerned with the risk reward being smaller than 1. In general, every trade is a swing trade and some trades are scalp trades. And most traders trading should be swing trading. So if you sell the close of 46, you could scalp or scalp part, 2 points, 5 points, something like that. Stop up here, or you could hold, go to Walmart, put a stop up here, and come back in an hour and see what you get, which is impractical. I think most traders who sold the close of 46 should get out above 48 or 49 and look to sell again. And we really did not have very good stop entry setups in here. So you'd sell again the close of 70 or 71, and this time you would have made a whole bunch of points. A lot of times you have to do something, you have to try 2 or 3 times and, make a little, lose a little, and then you get a big win. And that's very common in trading. All right, I'm losing my voice and really interesting to see what we're going to get over the rest of the week. Hope everybody has a good night.